Holds rates steady, but says more hikes might be to come. This market is relieved, trades as if we are at peak rates. We look at 3-year yields come in by 12 basis points, just a little bit less than that. Meanwhile, the Aussie dollar takes a dive. That is weaker by 0.9%. A quick look at futures, 30 seconds to go until this market opens. Pretty sour here, not that much movement to the upside. DAX underperforming, down 0.2%. FTSE 100 futures also down 0.1%. How much read-through will there be from weak China data into this European market, or is that all already priced in? CAC around little change, that is 0.1%. It is down 0.1%, as we now had 10 seconds until the start of cash equity trading here in Europe. So we're just starting to get it now. Let's flip up the boards and see how that is looking. Usually first out of the gate is the FTSE 100. That underperformed in the futures session. You can see it's starting to fall at this moment, down 0.03%. So not too massive of a move. We don't have any sort of macro force to weigh down on these markets this morning. It's all about the earnings. BP will be in this index. Again, now we're down 0.1%. BP, they surprised to the upside with their buybacks, much larger than expected, as did HSBC, two large components of FTSE 100 indexes. So that's likely to be an upward force on this index. However, France out of the gate, the most negative at the moment. That is down 0.26%. Earnings are going to be important here. Looking through French stocks, Diageo, not a French company, but it did disappoint with some of its earnings. We could see some of the other alcohol makers listed in France. That could be what drags us down. Dollar, that continues to gain. Just looking at a quick cross-asset picture, bond yields come in. That is the relief from the RBA. Okay, so we're still waiting for more indexes to open. Spain, that's down. FTSE MIB, little change. Just looking at some of the sector performance. Again, we don't have every market open, but we have most of them open at this moment. Banks are outperforming. Stock 600 banks. This is likely going to be a lot of HSBC with that surprise shareholder return of capital. That's going to be good news for them. Energy, perhaps this is BP. We'll get a check on those shares when we can. Up 0.2%. Down for a second consecutive day is technology. Basic resources, that also underperforming, down 0.7%. From what I can see, basic resources is the worst performing sector at the moment. Autos are down, so a lot of the cyclical, economically sensitive indexes are doing worse today. Let's dig through some of this and the big overall themes that we're tracking that impact this market with Sofia Orta-y-Costa from our Markets Today blog. Sofia, how much do you think what we're seeing today, some of the actions, some of the economically sensitive sectors being weak, has to do with disappointing data yet again from China?
I think the market is kind of split, Danny, between is bad economic data out of China good news because it means Beijing will be more forceful when it comes to stimulus, or is it actually bad news for the soft landing narrative that's really taking hold of markets right now? I think the difficult thing to read is we still don't have specifics out of Beijing into how they really plan to solve essentially what is a demand side problem, not a supply side problem. And most of the stimulus measures have been focusing on supply. We also, Danny, saw data out today in Beijing, in China, showing home prices fell more than 30%. That really shows that there's a huge housing demand issue there. And if China really wants to pivot the economy away from manufacturing and away from the property market to really important parts of growth that are, as you know, contracting, then it really, really needs to focus on the consumer story. And we haven't had that fiscal transfer that the market has been looking for. So I think there's still a little bit of debate around China. Is this going to help the global story, or is this going to be another kind of challenge going ahead?
It's not just China that's having some issues for housing housing prices. It's UK too. We also got UK data out about an hour ago.
Yeah, exactly. And depending on where you stand, if you're bearish or bullish on the UK housing story, there's something for everyone in that report, because yes, housing prices did fall, month on month and year on year, but they were a little bit better than expected. So again, it's kind of fits into the narrative that we're getting in the UK. UK data, economic data, the economic outlook here is challenging. No one's kind of doubting that, but it is a little bit less challenging than feared. The nationwide house price number we're getting here, the chief economist saying the relatively soft landing is still achievable. Again, that soft landing narrative really taking hold here in the UK. We also saw, Danny, another piece of good data showing that food prices are falling. And again, that fits into the soft landing, disinflation narrative that everyone's looking for evidence to kind of justify. I do think the BOE could kind of throw that into, make that a bit more interesting this week. But I do think there's a piece of good news if you want to look for it, and a piece of bad news if you're sitting on the bearish camp.
Again, comes back to this thing. You can read this exactly how you want, and that's what we've seen in U.S. markets. I mean, reading everything is positive, essentially, or reading everything is not important. We keep rallying. The eco data has been good in the U.S., to be fair. Really interesting story on the Bloomberg terminal, specifically looking at JP Morgan's hedge fund business, their prime brokerage services, and hedge funds just unwinding. It does seem that there's this fear, or at least this reaction to a more bullish market than many folks had thought it would be.
Yeah, exactly. I think there's a fear on both sides, right? Again, there's a fear of missing out on the rally. If you're not invested in this market, and a lot of people were, there was so much fear in the market, and the turnaround the turnaround from the kind of hard landing narrative to the soft landing narrative was so fast. I mean, Mark Cudmore is still very much in the hard landing camp, right? That you kind of missed out on this rally. And the AI story is still very strong. NASDAQ a lot stronger than feared. But now people are starting to get kind of worried that maybe we're traveling too quickly here. Maybe the economy, as Kolonovich says, is pricing in not even a landing. That it's starting to actually price in economic growth, and that's dangerous. So you're seeing some people wanting to pull back. The earnings picture, actually, though, is maybe reinforcing the fact that we are in a better economic picture than feared, and earnings really kind of feeding into the valuation story, that maybe valuations are not as, and I hate to use this word because I don't like it, lofty as people are talking about. So, but you are starting to see a pullback in the fast money, and I think that's really interesting.
I mean, I guess though, if we don't have an economic contraction or even just flat until next year, equity markets might be able to keep rallying until then. So all about timing. Sophia, thank you so much for joining, as always. That's Sophia Orta y Costa from our Markets Today blog, and you can get more from Sophia and the team on the front page of the Bloomberg UK website, or by typing TLiveGo on your terminal. All right, these markets, they are up and running, so let's get a check on some of the individual stock moves with Joe Easton. Joe, what you got for us?
So here's how the big UK earnings stocks are opening up in early trading. Danny, so HSBC and BP both up almost 2% in early trading. Now, those firms returning $3.5 billion worth of capital to shareholders between them, and they are two of the biggest stocks on the FTSE 100, so helping to support that index today. Meanwhile, Diageo finally starting to pick up. It did open pretty much unchanged. They're seeing weakness in the US spirits business, but Guinness looks pretty strong in terms of that company. Some of that US weakness probably already priced in, given some recent reports from the likes of Pernod in France. Meanwhile, Greggs, now that one's dropping. They've got around £80 million worth of pre-tax profit for the first half of the year. That's a lot of vegan sausage rolls, but that stock does trade at quite a high valuation. It trades around 20 times earnings, so it's coming off those highs at the moment. Probably just a bit of profit taking on that one. So we've done sausage rolls and pints of beer. We're going to look at a few other stocks that we had in the earnings this morning. DHL, this is the company rebranded from Deutsche Post, but DHL being their main delivery company. Now, their margins on some of their delivery business, not as strong as expected. They continue to come down following that pandemic boom. That's the continuing theme there. Meanwhile, Hyperport, this is a technology company that services real estate firms, and their real estate business really getting hit hard by these rising interest rates, which is putting so much pressure on that sector. And that's the worst performing stock we've got in Germany today, down almost 15%. Meanwhile, Man Group, this is, of course, the UK trading company and hedge fund, the world's biggest publicly traded hedge fund, down 6%. Some of their flows not as strong as expected in their equities business, according to analysts today, and that one getting hit hard. Then we're flipping over to sunny Mallorca, where we've got Melia Hotels over in Spain. They're doing a really good summer bookings trend, according to their latest report. That's in line with what we've seen from a lot of the airlines as well, in terms of EasyJet and Ryanair reporting a lot of strength over in Spain. And we're seeing the hotelier rising 2% over in Madrid. Finally, we're going to flip over and look at some non-earnings related stuff. There's Aston Martin down 1.4%. Up 150% already this year, so that is only a small decline for that stock. They've sold shares at a discount, so we're seeing that stock coming down to trade at around the price of that. Glaxo I've brought up because they had a positive drug approval from the FDA last night. This is a drug related to cancer, and it goes in line with chemotherapy, but not seeing too much there. It is expected to be one of their blockbuster drugs, but perhaps already in analyst estimates. Lloyds, meanwhile, continues the weakness from the UK bank that we saw last week. There's a lot of focus, a lot of scrutiny from regulators in the UK about them not passing on enough of the interest rate hikes onto savers. That was big headlines in last night's news, and we're seeing that coming down slightly. Telia coming back up slightly following that big drop we saw yesterday, as there was a shock announcement that their CEO is leaving. That one's been downgraded this morning by analysts at Berenberg, who say her exit puts their dividend in focus and potentially at risk. But that one, given it sold off quite a lot yesterday, coming back up slightly in Stockholm.
Joe, a fantastic roundup. You can truly see there that their earnings season dispersion, or I guess in the case of that board, non-earnings related news, it's truly back. Joe, thanks so much. Joe Easton from our equities team. Now let's get to some of the other stories you need to know. These are the most read stories on the Bloomberg terminal this morning. First off, Birkenstock. Bloomberg has learned that the owner of Birkenstock is planning an IPO as soon as September. Sources have told us that the listing by L. Catterton could value the iconic German sandal maker at more than $8 billion. Now, Bloomberg earlier reported that the private equity firm, which is backed by LVMH, is working with Goldman Sachs and JP Morgan on the potential share offer. Elsewhere, Bloomberg has also learned that Exxon is in talks with major automakers about supplying lithium needed in electric vehicle batteries. Our sources tell us that companies including Tesla, Ford, and Volkswagen will be involved in this. It's also having discussions with Samsung and SK On. Now, to the UK. Data from one of the UK's biggest mortgage lenders suggests that Britain's housing slump is deepening. We're just speaking with Sophia about this. Nationwide Building Society says its measure of prices fell 3.8% from a year ago. That's the most since 2009 and quicker than the 3.5% drop from the prior month. Economists had expected a slightly larger decline of 4%. Coming up, we're going to get back to the markets, specifically emerging markets, with our next guest who thinks the page is turning for EM credit. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
Today, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg's Sonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
Welcome back to Markets Today. About 15 minutes into the European trading day, we are seeing some green from the FTSE 100, likely a lift up from some of the big earnings we got, but elsewhere we are moving lower. The DAX underperforming, down 0.2%. All right, let's talk EM and specifically EM credit. We're in the midst of a very impressive run, and one way you can look at that are through credit default swaps. Here you're looking at the CDS index for emerging markets. It has fallen to a 19-month low. Let's talk more about this market. Joining us now is Trang Nguyen, Global Head of Emerging Market Credit at BNP Paribas. Trang, thank you so much for joining this morning. Great to have you in the studio. What do you make of that? Is that a momentum you want to ride, or is it complacency?
So, Danny, I think this has been a very refreshing change for a lot of emerging market investors. It's not been an easy few years. Emerging markets have been plagued by so many negative headlines the past few years. We were off to a very great start in January. EM credit was up 5%. We retraced fully, and the markets have been pretty range-bound for much of February through June. And in the past few months, or 2 months to be precise, we've seen a rally that's been very welcome. But I do think that while there have been decent macro reasons for the rally, we're looking at valuation levels which are looking quite frothy at the moment.
So do you want to start taking profits then? Is that what you're
Certainly,
saying?
yes. So we've been recommending some prudent profit taking in emerging market credit. So starting around February, March, we had been advocating for quality carry. And this quality carry for us was somewhere in the double B area, and they've performed very well. We've also argued that July is typically the best month for EM credit. And we're now in August. July indeed was a very good month for EM. The returns in July, nearly 2%, was roughly in line with the seasonal patterns that we've seen in the past 20 years. So EM has done what it's supposed to do.
So is it just that we've kind of run as far as we can, or are you expecting, for example, central banks to derail the rally or something to come in and stop this?
So let me talk first about investor behavior or investor psychology.
Sure.
So given the hard run that EM investors have had this year, I tend to expect this kind of FOMO behavior. And I heard this FOMO term used in the last segment as well. Well, investors are still looking to recuperate some of their underperformance this year. And in our analysis, funds are down roughly 10 to 15 basis points versus a benchmark. So I feel that there's probably some propensity or inclination to hold on to their longs before and close this gap before they go on their summer vacations.
Right. What about the distress complex? We had the IMF stepping in, giving $10.8 billion to Argentina this year. What do you make of that? What do you make of distressed EM at the moment?
Well, that's a bright spot now. So let's rewind. In the past 3 years, we've seen 11 sovereign defaults. In addition to, China high-yield property stress. So there's just been a lot of negative news. And there's been a major deterrent with the lack of progress in debt restructurings. But I do think that the page is turning now. We've seen some concrete progress in several countries. They're making progress. And I think we can see some light at the end of the tunnel now. Indeed, the CCC part of EM is a part that's outperformed, over 20% returns this year. Right. And now, if we near some of these conclusions by the end of the year, then it lifts some of the stigma associated with the asset class. So there's also been some major progress made by way of coordination in the global regime as well. The IMF, multilaterals, world leaders are all congregating to talk about the new financing pact, as evidenced by the Paris summit in June that was led by Macron.
Right.
So we are all discussing innovations and viable financing mechanisms for EM, and we know that to achieve any kind of ESG goals with regard to climate resilience, EM countries need to be part of the picture. So EM really is the forefront of ESG investing.
That is such a good point, that it's this coordinated effort at this moment. One part that's fallen short, at least of some expectations, is China in terms of the stimulus, maybe stimulating the economy, but not giving direct cash in hand to consumers. When you look at Asia EM as a whole, so not necessarily specifically China, can you bet on it, again, if you're not getting that direct stimulus coming out of China?
China has been very disappointing for us this year. I think early in the year, we were expecting that China growth outperformance versus the world would be a catalyst for EM outperformance. That didn't happen. Now we have stimulus. But I do think that even if China recovers from here, it's not going to be a major game changer for emerging markets because the growth model in China is different from what it used to be. Now, more crucially, and to maybe touch upon your question on central banks earlier, we need to be looking at the direction of the Fed, the ECB, and crucially the BOJ.
Right.
The Fed and ECB have shifted more dovishly last week, and recent data has also given some comfort around disinflationary trends. But the truth of the matter is the BOJ has turned more hawkish. And what it means is that there are still some challenges here for EM countries. And you can look at this two ways. One is the direct transmission mechanism from higher yields to lower prices. But the other, more crucially, is higher financing costs. And so a lot of the countries that have lost market access will still struggle to regain market access, and they'll have to resort to other sources of financing. Argentina and with the IMF.
Right. Trang, I'm afraid that's all we have time for. Really fascinating, though. Great to have you on the program. Trang Nguyen there, Global Head of Emerging Market Credit at BNP Paribas. Coming up, we get to another central bank, the RBA, extending its rates pause for a second month. I'll have more on that for you next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We're 23 minutes into the European trading day. FTSE 100 futures, the standout, not futures, we're in the middle of cash trading. Index, wow. You'd think it's Monday. Indexes there for the FTSE 100 is up 0.1%. Elsewhere, we are looking at declines. HSBC and BP, some positive earnings, positive stories about buybacks. That's what's likely lifting UK shares. All right, to Australia now. The central bank there, the RBA, kept its interest rate unchanged following a cooling of inflation pressures and weaker household spending. However, the RBA did leave the door open to future hikes. Let's get more now with Bloomberg's Valerie Teitel. Valerie, I mean, we were just talking about this in the break. The data has been bad, so perhaps this wasn't a surprise. But does this just go to further the peak rate narrative?
Well, look, the data has been bad in Australia. Let's just start there. They had a miss in second quarter GDP. They had a miss in retail sales, and then a very soft monthly CPI print. So I think a lot of the more nimble economists did change their view that the RBA would be on hold now. But they do, as you expect, keep that threat of an additional hike alive. Now, the market has really pushed that out to where that's going to be probably not until October or November this year. But still, peak rates for the RBA really are upon us. If the data does keep deteriorating at this kind of pace, another hike is probably unlikely from the RBA.
So what will it take them to drop that threat then? Does it have to get really bad? Because why even keep it alive at this moment when the data already is not so great?
Look, that's just kind of the communication strategy of central banks. They really don't want to almost pre-tell the market that they're heading into an easing bias until they're absolutely sure. You know that Lowe has had some communication problems, especially during the pandemic, the dropping of their own yield curve control issue before. They don't really want to give any hints away a bit too early, and that's really the risk of a lot of central banks going on at the moment, especially the Fed, even the ECB, right? They don't want to give any glimpse that they are thinking about cuts up until the second where they might be right upon us.
And we also know that Philip Lowe at some point will be succeeded by another governor, so perhaps hinting at what's at stake here with communication. Valerie, when it comes to the BOJ, we've seen open interest for JGB futures hit its highest in 23 years. The market has been moving, its third biggest move in the past decade. I mean, this is truly a market, again, the impact is being felt from what the BOJ did last week.
Yeah, I think what the market is telling us, both with the rise of JGB yields and the weakening of the yen, is that the market does not think that the Bank of Japan has done enough on this inflation fight. They do want more. They want a complete break of YCC, or they want a possible hint at a rate cycle upon us, right? Which you can tell the Bank of Japan is very hesitant to talk about. But that's just because they see inflation falling next year. They've got their 2024 inflation forecast at 1.9. Compare that to JP Morgan sees it at 3.5. If we do get that strong entrenched inflation, they are going to have to hint that a hiking cycle is on the way, else they risk quite a substantial weakening of their currency, and we already got a lot of that yesterday.
Yeah, I was going to say it has been weakening, even though they have tweaked YCC. Valerie, thank you so much for joining. Bloomberg's Valerie Teitel. Coming up, Man Group's assets hit a record level on inflows and investment. Our interview with the CFO is up next on Bloomberg.
business.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Markets Today, 30 minutes into your European trading day. BP shares jump after announcing a $1.5 billion buyback and a dividend raise. Second quarter profit was lower than expected. HSBC also gains in the London session on a fresh $2 billion buyback program. Second quarter top line growth and net interest margin beat estimates. And the world's largest publicly listed hedge fund reports a record nearly $152 billion in assets under management. In just minutes, we'll be speaking with the CFO, Antoine Forterre. All right, let's get a quick check on your indices this morning. The outperformer is the FTSE 100. That's thanks to some earnings coming from HSBC and BP, up 0.1%. Elsewhere, the session is soggy. DAX underperforming, down nearly 0.5%. All right, let's get to another big earnings interview now. And Man Group's assets under management have hit a record of nearly $152 billion. That was bolstered by fresh inflows and over $4 billion of investment gains during the second quarter. Joining me now for an exclusive conversation is the CFO of Man Group, Antoine Forterre. Antoine, thank you so much for joining. Great to have you in the studio. Look, we got to start with the reaction here because off the back of these earnings, again, you had strong inflows, a record AUM, but we're now down about 6% on Man Group shares. Likely because of the lower performance fees. I mean, what do you make of that, of the negative reaction to, again, a record AUM?
Thank you very much for having me first. We don't focus on sort of one-day share price move. The results, in our opinion, show that we have a very differentiated business model, resilient, and that we're not standing still. We had 2.6 billion of net inflows in the first half of the year, which we think is around 2.5% ahead of our peers, and led to record AUM. Our management fee on the run rate basis have grown in the period, $946 million compared to $917 at the beginning of the period. And then we announced a few weeks ago an acquisition, Varagon, which we think is a very interesting way to deploy capital for future growth. So we don't focus on the very short term. Right. We're here to deliver for shareholders over the long term.
Well, let's pick through a lot of that. How does the demand versus performance of some of the alternative assets look? Because the fees perhaps is on those alt performance. Is the demand still there? Because inflows surely for all of Man Group have been strong.
Demand is firmly there as the flows demonstrate. Listen, analysts focus on sort of quarter on quarter. They want to make sure that the numbers fit in a nice little Excel box. Clients really care about the long-term horizon. Last year was the best year since the financial crisis for us, on the back of 2021, which is also a very strong year. And at this point, most of our funds are up, flat or up year to date. So, we might have had a difficult March, we're talking about March here, but over the long term, clients entrusted with their assets have demonstrated with the flows in the period.
Yeah, unfortunately, you are the Excel spreadsheet man of the entire company, being the CFO, Antoine. This is your fate you've signed yourself up for. Look, you mentioned the entire hedge fund industry has struggled with flows. You've been able to consistently bring money in. Where is the demand coming from? What is the strongest segment that you're seeing?
We see demand across all institutions, so US institutions, Asian, Australia remains a strong pocket for us. And then over the last couple of years, we also see strong demand from the more retail to high net worth areas of the market. In the US, in Japan, and we've announced a partnership with a large private bank in Italy, also to tap some of that demand across the continent. So demand is broad-based, and the view is if you have product strategy solutions that are generally differentiated, uncorrelated, and liquid, which is what we provide, clients will follow. But the key is to demonstrate, as we've done, that you have genuine alpha over the long term.
I mean, last year it was a huge year for macro funds, for trend followers. What has been the most successful strategy in 2023, and what has struggled?
So we've had good performance in some of our credit strategies. Credit has done particularly well across the spectrum, discretionary in particular. Some of our discretionary stock pickers have also, navigated the world fairly well. Pockets have been softer, so we have a small macro strategies have been a bit softer in the first 6 months of the year. But overall, the alpha generation has remained very strong, around 1% alpha across the board. And, as I repeat, we're very focused about the long term.
Right. Well, I mean, in this environment where you have central banks, a lot is unknown. Are they at the peak? Are they going to turn? Perhaps more volatility in the market before that. Is this a period that hedge funds thrive in terms of flows, that clients look like them? What does this type of environment mean for you and for the industry?
It's funny, when people talk about this environment, it makes me think of the sort of old Looney Tunes cartoon where the character is sort of running above the air, and you're not quite sure if they'll sort of crash or if some sort of parachutes will appear and help them float. And the key word is uncertainty. That's what we hear, we hear with our clients. They're not sure how markets will react. And what we provide is firmly to address this uncertainty. We have strategies that are, uncorrelated, and clients have spoken with the flows that they've delivered.
And you mentioned this in your first answer. Buying a controlling stake in Varagon Capital Partners, the credit business, the private credit business. What are you seeing in terms of demand for private markets? Why make this move again into something different than Man Group has done for the past 100+ years of your existence?
So the focus for us is adding strategies, investment content that are different and differentiated, and Varagon firmly fits in that camp. We don't have a lot in private credit at this point. They're a very good investment team, very good investment culture, and we want to protect that. But we can also, feed that into our distribution model or solutions content and accelerate growth in that. Why private market? Private market in certain pockets remain an area of growth. Private credit in particular, with the banks retrenching, the yields where they are now, the sort of underwritten yield that you can get as sort of double digits for investment grade credit at this point. This is very attractive for large institutions, and if you can, underwrite this quality at scale, which is what we think we can do with Varagon, it'd be very exciting for clients and shareholders alike.
Is there some degree, because again, when I think of Man Group, I think of quant, a business you used to run. I think of that. I think of macro funds. I think of fundamental. I think of long equities, not necessarily private markets. Is there some degree where the business is now shifting? It's almost becoming a one-stop shop for investors.
A one-stop shop with a very strong focus on alpha and solutions. What we want to be is the provider of diversifying alpha content for large institutions. So if they have complex portfolio problems to address and they want strategies that are not sort of beta correlated, this is where we want them to come and see us. And by adding Varagon to that mix, we expand tremendously the range of strategies we can offer to clients.
Are there any other gaps in the market you see that you'd also be interested in adding on?
Credit is still an area with some gaps for us. We've had great successes with a few hires in Europe over the last few years. They've grown to around 12 billion of AUM. With Varagon, will be north of 20 billion. But credit in Europe and the US is a big area still with some gaps across the spectrum from sort of discretionary private to quant.
Would you ever do something like private equity?
Never say never, but I think at this point it's not a top priority for us.
Okay. Would you do more M&A though?
M&A is part of our strategy, has been part of our strategy for the last 10 years that I've been in Man. And if you think of Man, we've been built over the last 30 years through acquisitions. So when it's successful, as has been the case with us, it can be very, very additive. But we'll remain very focused on some of the criteria I described, a team that very good, that slots into what we do, doesn't compete. So M&A remains part of our strategy and will continue to be rigorous going forward.
So in a month's time, September 1st, Robin Grew will start as CEO. What strategy shifts will she be implementing?
Too early for me to tell, but I think Robin Grew coming as CEO, she's been in the business for 14 years. I've worked with her for all my career at Man. That's firmly continuity in a sense. But at the same time, with Anne Wade coming as chair soon by the end of the year, we'll have, and I think that's probably unique for a large asset manager, top leadership being female.
Right.
So it's continuity and progress, which are the two themes that I think we should remember here. Robin will come with her own energy, own views. She might change things over time at the margin, but again, she's been very involved in the running of the business and the strategy for 14 years.
I mean, to that point, what does it mean to have this, again, multi-century institution and now have for the first time a woman at the helm?
That's great. That's great.
Yeah.
It shows that progress is real, and it shows that the sort of talent pool that we can attract and retain is very diverse. So I think it's a great signal internally in our team, externally in the market, and importantly, I think the business continues to grow from strength to strength.
Yeah. How is the talent pool right now? We've seen banks over the past year shed some of their talent, try to downsize. Is that an area you look at? Have you been able to snap up any ex-bankers who want to turn to the dark side and work on the buy side?
We have, and we continue to invest in the business. We're firmly not aiming to sort of shrink to grow. This is a business that's growing, and we continue to invest in order to capture that growth. Investment talent has been one area, so we've picked some great teams from a few banks over the last year and a half, but not just. And the beauty of our model is we can attract very diverse talent and give them the environment and the structure and the comp structure that incentivize them to do well with us.
I mean, it's difficult, right? Because you often have to pay up for top talent at a moment where we're also confronting wage inflation. How much a thorn in your side is wage inflation?
Listen, when you hire top talent, you want to make sure that they stay with you and retain. So we'll make sure we remain competitive. But by applying technology, which, as you mentioned, is one of our strengths, we've been able to maintain the sort of operating leverage in the business fairly firmly. And this is sort of marrying of ability to attract talent in the UK and the US and globally on the one hand, and a very strong tech platform infrastructure from alpha generation all the way to kind of back office, middle office, enables us to have this model where we can grow profitably and increase margin.
All right, Antoine, a great note to leave it on. Thank you so much for joining us.
Thank
really
you very
appreciate
much
your time this morning. Antoine Forterre, their CFO of Man Group. Coming up, another earnings story. HSBC announcing a fresh $2 billion share buyback. We'll have our interview with CEO Noel Quinn next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today, 45 minutes into the European trading session. FTSE 100 shares outperform. Meanwhile, the rest of this market is little change to down. DAX underperforming down 0.25%. Now, one of the things that's lifting the FTSE 100 higher is HSBC. Shares are again up in London after the bank announced a share buyback of up to $2 billion. Chief Executive Noel Quinn spoke to Bloomberg about the earnings just a short time ago.
Those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth. But also all geographies contributed to that performance. So I'm pleased with the outcome. It's a $21.7 billion PBT, which produces a reported ROTE of 22.4%. But to be fair, I need to back out two notable items in Q1. Which boosted that return. But underlying then, excluding those, it's still a return on tangible equity of 18.5%. That's a very strong performance. Our confidence is high on the future, which is why we've changed our ROTE guidance going forward. We've increased it from the 12+ guidance we had before to a guidance of mid-teens for 2023 and 2024. And I'm really pleased that we were able to, because of our strong capital generation, commit to a further 10 cents dividend, interim dividend for Q2, and an additional $2 billion, up to $2 billion buyback, which we intend to complete in the next 3 months. So that's a good outcome. But I do want to say it's broad-based across all geographies and across all business lines.
Noel, from the outside, it seems you're promoting and putting a lot of focus on your business in India. Within Asia, is there a slight pivot away from China to focus on India?
No, we're looking to invest in all of Asia. We see great opportunities still in China, here in Hong Kong, but also we see opportunities within India and Singapore. And Singapore, not just for Singapore alone, but Singapore and its gateway into ASEAN. So we're investing equally between all parts of Asia. And we're seeing good performance across the whole of Asia. But also we're investing in new business lines for us. So I think in the past we've underinvested in our wealth business across Asia. We had a very good business here in Hong Kong. We invested in that. But we didn't invest enough in mainland China or in Singapore or in India. And we're correcting that now. And you can see the evidence of that in these results. You know, in Asia, we took in $27 billion of net new invested assets on behalf of our clients. And that, you know, if you look globally, in the last 12 months, we took in $75 billion of net new invested assets into our wealth business. That's a function of the investment program we started over 2 years ago.
So how active are you in helping, for example, to finance still some of the Belt and Road projects?
I mean, we look at all of those projects that are taking place, all of the big infrastructure projects. We're very particular focused at the moment on infrastructure projects around sustainability, new hydrogen plants, new wind and solar, ways to decarbonize. So we're working with our clients across all of Asia, but globally. We've done some big transactions as well in the Middle East, where we're looking to help clients invest in the new technology to build the new greener economy of the future. So we look at them on a project-by-project basis, and some of them are within the Silk Road, the Belt and Road Initiative, but some of them will be outside of that. Many of them will be outside.
No. How worried are you about Chinese real estate? And actually, if you look at what you've announced today, developments could be worse than what you're expecting, and will you have to take more fresh charges against some of your exposure there?
No, I think what we announced today was we do a scenario on what a potential plausible downside could be on that. We're not predicting that. We scenario plan that. We did take some additional provisions in Q2, but they were relatively manageable within our overall ECL charge. I think we took about 300 million in the first half of this year. That was top up on some existing provisions. But if I look at my overall ECL charge for the first half of the year, it was 1.3 billion, and that absorbed commercial real estate in China.
HSBC CEO Noel Quinn speaking to Bloomberg following a second quarter earnings results that pushed shares higher. All right, let's get you set up for your trading day and what else we're going to be on the lookout for. At 10 a.m. UK time, we're going to get Euro area unemployment data. Then in the afternoon, it's the turn of the U.S. U.S. jobs data will come out, which is expected to show further loosening in the labor market. We'll also have more big cap earnings. Pfizer earnings will come out, where evaporating uptake of Pfizer's COVID vaccine is the biggest reason of why analysts expect a plunge of 51% in quarterly sales. Coming up, the way we do business around the world is changing. We're going to take a look at the big forces transforming global commerce. We'll talk about our big take next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
This is Bloomberg. This Chinese markets today, over 50 minutes into European trading day. Some dispersion is back. FTSE 100 index, though, is losing steam. Little change now as the rest of the European market drops about 0.25%. All right, now it's time for your Bloomberg Big Take, which today looks at the $32 trillion a year of global commerce. The way we're doing business around the world is changing dramatically between U.S.-China tensions, the shift from fossil fuels, and the rise of AI. All of it is shaking up global trade. For more, let's bring in Bloomberg's trade czar, Brendan Murray. Brendan, a really fantastic piece here from you and the team. A lot of reporting went into this. What does the reporting tell us about what's going on between trade with the U.S. and China?
Well, we hear a lot about how the world economy is undergoing reglobalization, deglobalization, decoupling from China. There's just all these buzzwords. So what we wanted to do with this project was send reporters out into the field, talk to people, tour plants, tour ports, and tell us what's really going on the ground. Trade data inherently that economics reporters and economists look at is inherently backward looking. It's measuring things that aren't happening in the global economy now, lots more services trade. So really the best way to find out what's going on is to put on our, grab our notebooks and our tape recorders and go talk to people. And so that's what we did. We tried to paint a picture of what's happening. And I think what we found was really interesting.
And what was your overall takeaway then in that?
The big takeaway was we're at the very early stages of structural changes that are going to take a long time to play out. Now that's in a time when we like instant answers and change. That's not a great story to tell. But when you look at the details about what's going on, we went to Morocco, we went to the U.S.-Mexico border, we went to a factory in India, we went to a port town in southern Italy. So we got a really good sense of the changes that are happening. Some of them are obvious. Italy's gas pipeline is going to flow south to north now rather than north to south because Russian supplies are cut off and they need to get that from North Africa. Others are more subtle. We talk about the U.S.-China decoupling. Well, in Morocco, U.S. and Chinese businesses are getting along just fine. So there's a lot of variation. Companies and industries are doing this at different speeds, and governments now are, through industrial subsidies, are in this game trying to redirect supply chains to places that are more secure than they would have been in the past, as we found out during the pandemic.
There had been a lot of fear of reshoring, friendshoring, nearshoring, decoupling, what have you, that it would mean more inflation, that it would be bad for the consumer. What have you found in terms of ultimately the changes that you're witnessing mean for the consumer?
Yeah, in the short term, all of these changes will be more expensive. You have to build new factories in places like Mexico or Morocco. So there will be a lot of investment that's required. But over the longer term, technology will help reduce some of those costs. The higher labor costs, for example, that you might get if you shifted your production out of Southeast Asia to a place in Europe or let's say Mexico. So ultimately, short term it's going to mean higher costs, but technology will help reduce those costs in the longer term.
Brendan, thank you so much for joining. Again, a really fantastic piece. Really recommend everyone goes read it. That's Bloomberg's trade czar, Brendan Murray, on the Big Take. All right, some breaking news to bring you. BMW shares are plunging. They're now down about 2.5%. They were higher this morning after seeing their EBIT margin 9 to 10.5%. That actually is an upgrade. It did see 8% to 10%. Their auto segment, that's also wider too, higher rather, 18% to 22%. And even still, BMW shares falling off the back of that. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up? What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's factory output unexpectedly contracts in July, while home sales drop the most in a year. Beijing pledges to boost private credit. BP raises its dividend by another 10% and says it will buy back another $1.5 billion of shares despite missing profit estimates with weaker oil and gas prices. We'll bring you more of our interview with the chief executive, Bernard Looney, plus another $2 billion in buybacks for HSBC shareholders as the bank's second quarter pre-tax profit actually beats estimates. We'll bring you our interview with the chief executive, Noel Quinn.
Those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth.
Now, also coming up, our exclusive interview with Bank of America's international president. He's Bernard Mensah, and that's at 9:30 a.m. London time. He'll be joining us here in the studio. Now, let's take a look at the European markets map to have a look at where we fall in terms of earnings. Again, it's been a busy fortnight in terms of earnings that disappointed. Overall, most of them actually did a little bit better than expected, but when you disappoint, you get slammed by a lot of investors. Happy August, or will it be? Well, while European stocks have rallied over the past 2 months, seasonal trends also have historically pushed the Stock 600 down in August and September. I think we have a chart looking at that very thing. And then RBA, it's paused. The Central Bank of Australia decided to not raise rates. Deutsche Bank calling it the end of that tightening cycle. The next test is on Thursday. Traders split between the BOE hiking 25 and 50 basis points. I keep on hearing this is definitely going to be a decision on knife edge. And then more pressure in China. Property developer Country Garden said to have canceled a share placement. Worries are growing about the company's liquidity and the country's overall property sector. Now, compounding concerns, of course, the Kaixing manufacturing PMIs showing a contraction in July. Well, joining us to talk about the markets, to take stock of the week that's been and the week that's coming, Guy Foster, chief strategist at RBC, Bruin Dolphin, Bloomberg, Sofia Orta Acosta. So thank you both for joining us. Sofia, you're an expert on everything China. I don't know whether, and I know we have the PMIs and the Kaixing, which are worrying. I'm really worried about a possible default or something in the developing, in this developer world. Is the PBOC going to have to support them, or are they happy to have these like bursts, bubbles being burst here and there?
I think that's what the market's trying to understand, Francine. I mean, Country Garden, the developer that you mentioned,
It was the biggest developer in China by contracted sales, so it's not a small developer. This is kind of, when you consider how much the market was panicking over Evergrande 2 years ago, and now something like Country Garden happens, and we're all kind of calm and carry on. It really kind of shows whether it shows that China has kind of managed to manage this downturn relatively successfully. I think there is some concern still about defaults here. The fact that Country Garden was trying to sell shares into a market that was supposedly more positive. We were, you know, in a kind of environment where people were looking at China's stimulus and looking at what Beijing was doing to support the equity market as a positive going forward. Country Garden had to cancel that share sale plan. So it really shows that it's very, very fragile sentiment in the market right now. Also, Francine, you know, the property sales data out today, down more than 30%. There's still so much work to be done there.
Yeah, and this is what I don't understand, is that actually, are we reading it right? Right, when you look at China, and with Sophia's excellent explanation of what's happening with some of the property developers, should we be more worried, or is there just a general belief that authorities will deal with it?
No, I don't think there is that general belief. I think there's, as Sophia sort of explained, I think there's real confusion about where the government's stance is, or where policymakers' stance is on some of these key industries, and real estate's obviously right in the nexus of that. And we go from 1 year to the next with an industry being the best friend of policymakers to suddenly being its enemy. And it's really, really unclear at this stage how orderly the adjustment in this sector is going to be allowed to be. But certainly it's also really unclear how effective a policy stimulus can be in China if it doesn't really involve the real estate and construction industry.
But Sophia, so are they just holding back and actually waiting to put a little bit more stimulus, you know, at the right time, or are they worried that if they do it too soon, it doesn't actually have the intended effect?
You know, Francine, I think for me, the most interesting part about moving here is actually the questions people ask about China. Why doesn't China bring out the big bazooka? Why doesn't it just bring out more stimulus if it has the tools and capacity to do so? You know, I think there are, as you know, as Guy said, confusions over what that big bazooka would be and whether it would be effective or not. The one thing I think, Francine, that the market is looking at right now and really focusing on is the fiscal transfer to consumers. So anything that consumer checks, because stimulus so far has been focused on the supply side, and China really has a demand side problem. The property downturn is a really, really important factor of that, because people don't feel good about the economy. They, you know, the majority of household assets are in property, and if essentially your nest egg is losing value, you're not going to want to spend. I mean, that's the last thing you want to do. So very kind of sentiment-driven behavior problem that China needs to fix. I do think that, you know, looking forward, the 20 points that the State Council mentioned this week or last week really got the market excited, because it seems like this time is different. So I do think we're getting a little bit of a narrative, maybe kind of wishful thinking, that this time actually Beijing will deliver the policies that it has been promising all year. But so far, not only have they not been enough, but they've also been ineffective.
But you wonder also whether they worry that if they put them in place, and it really means that they're looking at something ugly. So it's the kind of self-fulfilling prophecy almost if you do too much too quickly.
Exactly, Francine. But I would say, kind of just to counter the gloom a little bit, there was a huge concern that when China reopened, the post-COVID China economy would bring inflation into the world. And that was, you know, as recently as November, I was having heated debates with people outside China who were saying this, you know, let's worry about the inflation story coming out of a reopened, kind of booming China economy. We don't have that. And China's actually going to export disinflation because producer prices are still very low. So I think there's kind of an optimistic tilt there. China may add to the soft landing disinflation narrative elsewhere.
Yeah, and actually, if you look at a bit more optimism, the chart of the day is looking at foreign investors, Guy, returning to China's stock market en masse. Now, en masse, again, it's an overall, it's not a huge amount, but it is actually much bigger than it has been in the last couple of months. And I don't know whether that's because they're optimistic or they're just trying to call bottom.
I think it's the latter. I think we're getting to a stage where the bear case is that China has lost all of the policy measures that it would be able to rely on in the past to drive growth. And the bull case is that level of pessimism tends to indicate buying opportunities. And when we look at the charts, you know, last week was quite important in just showing that the market's really breaking out of what have been quite a persistent downward trend in China. So I think it is a crucial point to see if that confidence can be retained.
So, Guy, how do you buy into China?
We've got fairly modest but broad exposure across the Hong Kong sort of entry points and a bit of ADR exposure as well.
Okay, interesting. Thank you both for joining us. Bloomberg Sofia Artai-Costa there joining us on the China market, and RBC Brewin Dolphins Guy Foster stays with us. Lucky him, he'll get to talk about banks shortly. Coming up, HSBC announces a new buyback program as higher interest rates propel profits. So we'll hear from the bank's chief executive. That's next, and this is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Tuesday, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg Sonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
We see great opportunities still in China, here in Hong Kong. But also, we see opportunities within India and Singapore. And Singapore, not just for Singapore alone, but Singapore and its gateway into ASEAN. So we're investing equally between all parts of Asia. And we're seeing good performance across the whole of Asia. But also, we're investing in new business lines for us. So I think in the past, we've underinvested in our wealth business across Asia. We had a very good business here in Hong Kong. We invested in that. But we didn't invest enough in mainland China or in Singapore or in India. And we're correcting that now. And you can see the evidence of that in these results. You know, in Asia, we took in $27 billion of net new invested assets on behalf of our clients. And that, you know, if you look globally, in the last 12 months, we took in $75 billion of net new invested assets into our wealth business. That's a function of the investment program we started over 2 years ago.
So how active are you in helping, for example, to finance still some of the Belt and Road projects?
I mean, we look at all of those projects that are taking place, all of the big infrastructure projects. We're very particular focused at the moment on infrastructure projects around sustainability, new hydrogen plants, new wind and solar, ways to decarbonize. So we're working with our clients across all of Asia, but globally. We've done some big transactions as well in the Middle East. Where we're looking to help clients invest in the new technology to build the new greener economy of the future. So we look at them on a project-by-project basis. and some of them are within the Silk Road, the Belt and Road Initiative, but some of them will be outside of that. Many of them will be outside.
HSBC Chief Executive Noel Quinn there speaking to me a little bit earlier about the bank's opportunities in Asia. Now, it's also announced this new buyback program as rapid interest rate, of course, rises, boost profits. We also talked about the UK. Let's get more now with Bloomberg's Tom Metcalf, who oversees all of our banking coverage here in London. Still with us also Guy Foster, Chief Strategist at RBC Brewin Dolphin. So thank you for sticking around, Guy. Thank you for coming on, Tom. I mean, if you look at HSBC, much like a lot of the big banks, they're giving back because they're making more profit thanks to higher interest rates. Is that the kind of the simple answer, like the simple question?
Yeah, so ultimately at its core, it's a net interest income story, and HSBC, like most of the other lenders we've seen this quarter, you know, those rise in rates boost profits, and in HSBC's case, they've turned to buybacks. They've gone to a second interim dividend. Of course, you know, you hear the CEO talking about their strategy is working, but I do, you know, they probably wouldn't be working quite as well without those rate rises.
Yeah, but at the same time, so we tried to, you know, get him to explain whether they're shifting a little bit away from China to focus on India, and he wouldn't go there really.
Yeah, I mean, look, it's a fraught topic, and you know, they're definitely talking about expansion, not just in China, but ultimately this is, you know, a Hong Kong-focused bank, really, you know, mainland China-focused. So they're looking at maybe expanding in areas like India, but when you look at the balance sheet, it's still very much, you know, a Hong Kong first.
And he's very committed to the UK, despite actually also saying that they needed a building, you know, half the size of what he had in Canary Wharf.
Yeah, no, that's a fascinating sort of move there and kind of have big implications for the City of London. But yeah, no, look, they've got a huge ring-fence bank, and the way I think HSBC look at it is you've got sort of a pillar of strength in Asia, and then that huge deposit base in the UK as well as another sort of pillar of strength, and then they can kind of overlay various sort of global businesses across those.
Okay, are you invested in banks, either UK or globally?
We have indirect exposure to banks, but it's not like a sector that we really focus on because we tend to have a bit more of a sort of high margin quality sort of a focus on businesses that are slightly more master of their own destiny, slightly less dependent upon the policy environment, as Tom was talking about.
But if you look at some of the European ones, I mean, they look pretty attractive, or certainly pretty cheap compared to the US ones. So is it a business model that you don't really understand because they're so vulnerable to interest rate rises and falls, or is it just because you're seeing more value elsewhere?
Yeah, just better types of businesses really that we prefer elsewhere. But I would agree in valuation terms, in Europe and in Japan, I think there's quite a lot of appeal compared to the sort of +1 times book that you see in North America. So yeah, there's definitely opportunities. Hence, we do have some indirect exposure to those markets.
I mean, last time Tom had a full weekend was like in 2018, because there's been crisis after crisis, or mergers, or I mean, there's always something going on in the banking world. Is there a main takeaway of, you know, the challenges, if not regionally, country by country?
Yeah, well, I think it's the special nature of finance, right? Like, you know, we saw with NatWest last week, you know, there is a ton of government sort of attention on this area. So it's just a very difficult, very complicated business. And, you know, you can certainly understand why investors are sort of, you know, sort of looking at these banks going, do we really want to be involved in something which, you know, could suddenly change?
Were you surprised by the strength of a lot of the American banks, certainly compared to some of the Central European ones?
I think, you know, strength of American banks is something I'm now pretty familiar with, and you know, so it was not surprising, you know, JP Morgan's, Bank of America's of this world coming out strong. I think, you know, on the European side, looking quite generally, it's really been pretty positive all round. So similar results really to HSBC with these, you know, buybacks coming through. So on the continent, at least, it's looking like, you know, sort of very positive quarter. And then you look at the UK, and it's a bit more of a mixed picture with Barclays down as well as NatWest.
Guys, is there any other sector? I mean, if you're not crazy about banks because they're not masters of their destiny, what sector do you like the most?
Well, I mean, I'll qualify that by saying I do think there's an opportunity in Japanese banks at the moment with the monetary policy change that is taking place there, and based on the fact that actually they are probably the lowest valuations in the world and don't have, despite there being an extensive regional bank sector, it's not got the same sort of regulatory problems that you've got in the US. Insurance, then, we're a bit more kind of constructive on that within financials, but really I think probably more of the growth-orientated sectors, particularly industrials, semiconductor, capital equipment, things like that. So those are the kind of sectors that we've been buying more of just recently.
Okay, the BOJ certainly gave us a little bit of heart palpitations between last Friday and this Monday. What's your take? What do you think the BOJ does until, maybe mid next year? Do they actually move on yield curve control?
Then they have to see how much buying they need to do to keep yields in the sort of 0.6s where they would presumably quite like them to be. In an ideal world, we've just had obviously no take up on the fixed rate buy up. In an ideal world, they end up buying a lot less bonds, and there's a sense that the market has returned to equilibrium. From an investor's perspective, I think we'd like to see them having to work a little bit to keep yields where they are, because that will make it quite clear where the trajectory of yields is going to be in the future, and that's makes it easier to position for.
All right, thank you so much both for joining us. Guy Foster, Chief Strategist at RBC, Brent Dolphin, and of course our very own Tom Metcalf, all over the banks here in the UK and Europe. Coming up, Diageo says it's been able to pass on price increases to consumers as sales beat estimates. So we'll hear from the chief executive of the world's largest distiller next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Able to pass along the price increases that we needed to. But, look, we are being very surgical about it. We're seeing inflation kind of moderate as we go forward. So, that should help us kind of navigate this and not have to take so much pricing. But, we do watch this carefully. We do have a lot of other levers, though. As I mentioned, we have a lot of aged product Aging, of course, helps us.
So Deborah,
is
this the end of price increases then? Are you going to do any more then if you do see inflation coming down? Is this the peak of that?
Look, I mean, we have to see what's in front of us, and we'll navigate that, appropriately.
Deborah, I am impressed how you managed to mention putting consumer at the heart of all your decisions in a conversation about price increases. But that is a good sales pitch. I'm curious, you talked about the premiumization you're seeing within your brands generally globally. Are you seeing that ongoing premiumization from the consumer in China as well?
Yeah, I think, look, in China, I mean, China is still, it's small for us. It's largely an opportunity. What we saw in our results this year, we're one of the few Western companies with the Chinese white spirits business. That was quite negative for us this year because of the lockdowns. Baijiu, Chinese white spirits, is mostly consumed in banqueting and gifting. So these activities were just shut down, and they're really just coming back. Actually, underneath of that, our Johnnie Walker and Scotch business was up double-digit. So, we're seeing kind of China come back. It's a little bit slower than what we expected, but we're seeing that come back. We feel good about the opportunities in that market.
Deborah, where I am here in the UK, increased alcohol taxes are coming to the region. Do you see that affecting demand at all?
Yeah, I mean, look, we had said to the government back in March that this would be a hammer blow ultimately for hard-pressed hospitality. And ultimately the consumer. So, it certainly will be a headwind for us, here in Great Britain. About 75% of every bottle of whiskey that you buy in GB goes to the government.
That was the Diageo Chief Executive Officer, Deborah Crew. Their shares in the world's largest distiller higher this morning after Diageo actually reported sales that beat estimates. So let's look at Diageo, but also the other two big companies that reported earnings today, all on the higher side. So if you look at HSBC, they announced fresh buybacks. Higher rates definitely propelled profits that were around $8.8 billion for HSBC, getting some 2.7%. Diageo shares up. Again, the distiller able to pass on some of these higher costs to consumers, and then BP caps some of the big oil earnings with a focus on cash for investors. The other story watching out for is BMW. Those shares are falling. This is after they warned that parts expenses will weigh on some of their cash flow. BMW down 3.8%. Now, coming up, we'll have a good and exclusive conversation with Bernard Mensah. He's Bank of America's president of International, to discuss the new Fed rules around excess capital. We'll also talk about the way forward for banking internationally. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
This Friday, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Well, China's factory output unexpectedly contracts in July. Home sales dropped the most in a year. Beijing pledges to boost private credit.
Connection lost.
BP raises its dividend by another 10% and says it will buy back another $1.5 billion of shares, despite missing profit estimates with weaker oil and gas prices, plus another $2 billion in buybacks for HSBC shareholders, as the bank's second quarter pre-tax profit actually beat estimates. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So it's been a strong earnings season for Wall Street, despite tighter credit conditions and the upheaval from the collapse this year of the 4 U.S. regional lenders. Now, Bloomberg Intelligence says tougher regulation from the Fed can now raise $126 billion of excess capital at the biggest U.S. banks. Well, joining us to discuss this and much more is Bernard Mensah. He's Bank of America President of International. Bernie, thank you so much for joining us. There's so much to talk about right now in the banking industry.
Thanks for having me on.
It's an absolute pleasure. When you look at a lot of customers, when you look at what's in the pipeline in terms of IPOs, in terms of revenue growth, where do you see the green shoots coming from in the next 6 months?
I think the green shoots are broadly the fact that the market is assuming that the Fed might be near the end of its cycle. So there has been excess savings, excess capital. The question has been, when does it get put to work? We're about halfway through the reporting cycle of U.S. investment-grade companies, I think, around about now. And I would say that there's been something like 4 to 4.1% beat in terms of upside surprise. It was about 5.5% in the last couple of quarters. So things are not looking too bad. I think corporate balance sheets are in a good place, and they're really waiting for the capital markets to open up.
Yes, when will the capital markets open up? And what I keep on hearing is that actually, in terms of deals and IPOs or even M&A, there's a mismatch between what some of the sellers want in terms of pricing and what people are ready to pay for them. Does that match up at some point?
Well, I would say we're super busy, and our pipeline is, and so there is this pent-up demand. In terms of the market pricing, it's been really a question of, sort of liquidity and where you can get your deals done. Some of the pricing mismatches have probably been more in the private markets and in specific sectors where there were very high valuations before, and there's some valuation adjustment that's needing to be taking place. But I think in the public markets, it's really a question of when the markets open up and where you feel you can get your deal done.
Yeah, and this happens, it's of course about inflation, what the Fed does in the U.S. economy. Are you optimistic about the U.S. economy and the world economy in the next 12 months?
We have, our research has been postponing the U.S. recession for a few quarters now. They now tell me that, perhaps a couple of quarters next year might be a gentle one. We've already seen the U.S. consumer as being in a very good place and a very robust place. So that's always given us a certain confidence that the underlying economy is doing well. Unemployment levels at 3.5%. And we have at Bank of America a very good perspective on the U.S. consumer. So that feels good. I was in Asia last week. I was in Japan and in Korea. Now, there was a sense that the Chinese economy was a little bit slower than we generally expect. I was talking to a very senior person there who was saying that generally it is a surprise to the upside, and for the first time he thinks it might surprise a little bit to the downside. But beyond that, I think generally things feel reasonably decent.
So you don't see any stress in any of your customers or consumers in the US or elsewhere?
It's really interesting. The CEOs and the senior corporate executives I'm seeing, they're an incredibly, I think, impressive crew. They've managed through a bunch of different crises recently. I think they're on the front foot in terms of technology, in terms of things like the Inflation Reduction Act, in terms of where the global economy is. They're on the watch out for stresses, whether it's commodity markets, whether there's specific macro things like in Japan, you just had this sort of slight change in yield curve control type issues there, what the Chinese economy is doing. But people seem to be on the front foot, right? As of now, it feels as if we've come through, perhaps we've come through the worst. Let's see.
Bernie, when you look at some of the new rules that actually could apply to U.S. banks in terms of regulation, what does it in effect mean on how the bank is run or where you focus your attention on?
Yeah, so we've been anticipating this for a while. We in the banking sector feel that we're very well capitalized. We go through our annual stress test, and I think we've sort of proven that. The new rules will mean a reallocation of resources. It'll make certain instruments and certain activities more expensive and others less. We believe our peers are in a good place to manage through that. Some of the aspects we think are a little bit of a shame. You know, the trend was heading towards more model-based approaches, and it feels as if what's colloquially called the Basel III endgame, or the expanded model-based approach, is a little bit less of that. So we'll manage through that, but we'll have to be sensitive to the fact that different asset classes and different types of activity will be more or less expensive.
Are you expecting regulation to stay the same in Europe? There doesn't seem to be anything that could change, but I guess that's one of the biggest concern for banks, that suddenly there's, in the UK or elsewhere, a kind of realization that things could be done differently.
Yeah, well, with respect to the Basel rules, the EU seemed to have had its arguments a little while back, and there's a lot of debate around the output floor. And just in the last 4 to 6 weeks, a settlement was reached with the Parliament and with the EU and the Commission. So that's sort of in execution mode. And my sense, there might be better experts there, is that what the capital cost is anticipated to be hasn't changed so much in the EU. I think it's in the US where the rules have just landed, and there's lots of reports as to whether it's an 18 or 20 or 22% increase. And that will differ from institution to institution.
Bernie, it's also really interesting. Bank of America is a great benchmark to try and understand some of the underlying growth prospects for individual countries. I don't know how Europe feels right now. And again, when you look at the PMIs, when you look at a lot of the data, it's quite contradictory. What are you seeing on the ground?
I think in Europe I'm seeing, we're predicting something like a 0.5% growth rate for this year, and a slight increase, maybe 0.7% next year, 1. 2, I think Europe has adjusted through the energy crisis quite well, and actually has accelerated investments in renewables that over the medium term should be less expensive. 3, a lot of the corporate C-suite have been seeing, I've spent quite a lot of time in Europe recently, had been focused quite a bit on the Inflation Reduction Act that came through. And there was a sense maybe 6 to 8 months ago that that's where investment is pointed. But the EU itself, with its EIC, I think, which they have put together, is countering that to some extent. My argument was it was never a question of the amount of money. Europe has a huge amount of money, whether it's from the SURE program or other financial resources. I think the real point for the EU to focus on was speed of execution, speed of approvals, making it easy to access whatever incentives there might be, and I think there's been some progress with that.
But we speak to CEOs, and actually the Inflation Reduction Act is such a catalyst for a lot of the investments. You're even hearing from European chief executives saying, well, actually, I'd want to invest in the US and certain states first and then look elsewhere. Are you seeing this pattern, and is it certain sectors, or is it almost across the board as long as they can tap into the Inflation Reduction Act? Yeah, so exactly that. I would say 6 to 8 months ago when I was in Europe in Q3, Q4 last year, there was a lot of talk of that. And perhaps we are Bank of America to some extent, although we're as big and local here and very global, but a lot of people are asking about the possibilities there. I'd say that has shifted a little bit, where there's a little bit more of a realization of the opportunities within the EU itself. And as I mentioned earlier, I was in Asia last week, and there's a big focus there, perhaps a little bit more on the US than on Europe. So if there's a relative balance, I would say the US benefits from EU interest and East Asian interest,
and perhaps the EU doesn't have as much East Asian interest in EU possibilities, and maybe that's the next step for European regulators to think through.
Is there any part of the world that you're looking at hiring right now quite significantly because you want to grow out a business there?
I would say that, with respect to our headcount, we've tried to manage that. Our industry has seen a lot of announcements about headcount adjustments, as it were. And we tried to manage that by just reducing our rate of hiring and redeploying our crew. Because every year we hire thousands, tens of thousands of people. So what we tried to do is to say, well, let's lean into the attrition, because we have people leaving and we have people coming. So we feel good about the fact that we've managed that process well. And what we've tried to do is to redeploy resources that we have, excellent resources where it's less busy, to areas where it's a little bit more busy. I mean, we saw big reductions in capital markets, but that might come up again. Globally, we are really well balanced. We feel really good about the places that we're in. We're incredibly global. There's very few financial institutions of our scale to be able to operate on the scale that we do for our real global clients. And we move with a different sort of GDP growth prospects best we can.
I know we'll talk about AI and technology in a second, but what's your take on the UK right now? So it seems to be an economy in transition, and so I don't know what that means for a big US bank here.
Yeah, so I guess the UK has it. The Bank of England has its rate decision this week. The markets are pricing.
Knife edge.
Yes.
It's quite exciting.
Yes. Well, I tend to look at what the markets are pricing. I think it's, I don't know, somewhere between 35 basis points. We'll see. The inflation outlook felt a little bit stickier here than elsewhere. I do think all global economies do need to think through the supply side as well as the fiscal side and the monetary side of things. And the UK absolutely needs to do that as well. For us, as a global financial institution, we're here. It's our largest country that we're in outside of the US. With respect to investments in Europe, recently we made a lot of investments in France and actually in Germany and in Italy and in Scandinavia, where I was a few weeks back. But the UK remains, whether we're in London, we've got 1,200 people up in Chester, and so it remains a really important base for us.
All right, Bernie, thank you so much. Bernard Mensah, Bank of America's President of International, stays with us. We'll talk a little bit more about the UK, and we'll also talk about technology and AI. That's coming up shortly, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London. Now, with me on the show today, Bernard Menza. He's Bank of America's president of International. Bernie, thank you so much for staying with me. We had a good conversation about some of the capital markets, what you're expecting some of the clients to do and to behave. We talked about, I think, inflation. We started talking about the UK. Now, some of your rivals have decided to go full in and actually have a retail presence here in the UK, either digital or actually with branches. Is it something that would tempt Bank of America?
No, we don't have any plans for that. You know, we have a huge retail business in the US. We think it's a best-in-class business. And I do think if we wanted to do that globally, we would be very good competitors, but it's not our strategy right now. We have a great wealth business that's in the US as well. So internationally, it's our corporate banking, our investment banking, our sales, and our trading business.
What about payments?
Exactly. That's really a part of our corporate banking business, our global transaction services business. We're super excited about that. It's a top 2, top 3 player globally. It's often not talked about. It's often not as, whatever word I may use, glamorous perhaps as some of the other businesses that we do. But we provide an excellent service, technology-based, digitally based, and it is often the first conversation we have with growing companies and with large global players, whether it's the US large companies going global or large Asian or European players. It's a terrific product, and we're very excited about the power of that franchise.
You mentioned glamorous businesses. We talked about how you're traders. That's a pretty glamorous business. Are they going to do as well as last quarter? How's it looking?
Well, it's interesting. We had a really good quarter last quarter. We outperformed pretty much all of our peers, and if you go over the last 2 or 3 quarters, we've continued to do that. We put more resources into that space. We have, again, a terrific global franchise. We have a best-in-class research platform, top 1 or 2 every year, and etc. So that underpins the global offering that we give. And those trading businesses and the franchise that drives that is really driven, I think, by the global platform we have and the breadth of the franchise that we're constantly building. You never know what the markets will give you. My background is in trading, but we feel really good that insofar as our clients have questions to ask about where the economy is headed in the macro space, and what the corporates need to do and what our capital markets can bring to the table, we're just as competitive.
I mean, as a markets guy, and I think if you're a markets guy, you're always a markets guy at heart, right? What do you find bizarre at the moment in the way that bonds or equities are behaving?
I'm not sure if I'd call it bizarre. I think what I might say is that I worry. You're always worrying a little bit as a markets person. What can come and trip you up? And so at the moment, you look and you're sort of thinking, what are the clouds in the sky? You're searching for the clouds. And so there are a bunch of macro backdrops that you sort of think should worry you, but things seem okay. So so I think that's what just keeps me up a little bit. We saw in Japan the slight move in yield curve controls. We'll see what happens with corporate earnings seem to have been okay. Inflation, the idea of a Goldilocks landing is something that not that I didn't believe in, but you're sort of skeptical about. And I think that some of the fast money managers had also positioned a little bit not anticipating that. So I think it's more that.
Bernie, when you look at technology and AI, how does it change banking, and how is Bank of America going to use it?
Yeah, well, I think it changes us in a number of ways. Internally, of course, we lean into all the new technologies. We've used a lot of machine learning processes. If you take, for example, our voice-activated Erica sort of platform in the US. And then with respect to AI patents, for example, we've, I think, registered more than anybody else. So we're leaning into the new technologies. But importantly, we think it'll change things for our clients. I think it'll disrupt some businesses and some economies. And I think we need to be very alert to what the impact might be, down the line. So it's something that we spend quite a lot of time on.
So this is what, maybe voice recognition that gets used in bad ways if there's an AI algorithm? Like, how do you, at this point in time, where we're not sure where we end up in AI, look at the good thing with AI and how it can help banking, and the things that you should really worry about and spend more money in trying to prevent it?
Absolutely. So on a bank of our scale, you've got things like the cybersecurity aspects, you've got voice recognition aspects to it, but then you've also got consumer interactions that can help you with. And then what we have are, in a bank like ours, huge amounts of very high-value data sets, large data sets that could benefit from machine learning or sophisticated machine learning AI-type applications. And I think that's where we need to think through. And then further on, for our clients, which is who we're here to serve, really thinking through what that might be. We host a breakthrough tech event that we've been doing for the last couple of years. We had one a couple of weeks back, and a lot of that was to step back and sort of say, what happens over, what happens tomorrow? Fine, we discussed that a lot, but that process also allows us to step back and say, what happens over 5, 7, 10 years? What are some of the things that might come at us that we don't anticipate?
And so what does it, again, when you look at banking, does it lead to job losses, or does it change the nature, for example, job at bank tellers because you use an AI kind of algorithm or person to do that, and so you create more quality jobs?
Absolutely. So that sort of machine or automation has been in place for a long period of time. When I started in the industry, we had a lot more FX traders for a lot smaller amount of flow. Now we have, and not just us, others have auto-coding, auto-execution algorithms. There's legislation around that. We need to manage all of those well. So I think that has happened. If you look at our retail space in the US, the number of new retail accounts and digital accounts that we're able to take on every week, every month, we couldn't do that without the help of machines. So I think that's already happening, and so it allows us to invest and grow in other areas, and it allows us to manage increased capacity with what we have. I think we have something like 18 to 20 million users of Erica constantly, over 100 million interactions monthly, quarterly. So that is already helping us to be super efficient, super productive. What we're really trying to think through is what's the next stage, as you were asking before. How can we use that to really drive further interactions, whether it's on the research side, whether it's on AML, KYC, and I'd say one of the most exciting things for me around AI is actually the coding enrichment, the fact that you have applications that allow you to ask in normal language for coding for certain activities. So it means that the huge amount of money that we spend in basic coding can be automated, which frees up those computer scientists to spend time on other things. So I think part of my point on the AI, sort of revolution out there is that it's a lot more subtle.
Yeah.
I think it'll be a lot more diffuse. Yeah. I think the impact will be a lot broader, and we won't realize it over a period of time. And the piece where we see it, which is going into ChatGPT-4 and asking it a question, I suspect will be a small part of what it's all about.
So interesting. Bernie, thank you so much for joining us. That was Bernard Mensah, Bank of America's president of International. Coming up, BP also follows a pattern set by its big oil peers, returning more cash to shareholders despite a profit miss. So we'll have the details next, and this is Bloomberg.
The IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Earnings season is here.
Decent start to earnings season. We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
In terms of valuation gaps that people speak about, not necessarily within the European companies, but versus the United States, it's simply a question of focus and delivery. We've got real plans to grow this company materially over the next couple of years. Between now and 2025, we intend to bring on 200,000 barrels a day of new production from new oil and gas production from major projects. We're going to double our biofuels production. We're going to double our biogas production. We're going to grow the business, and a business in our growth engines that was delivering $700 million just in the first half of this year will be delivering $3 to $4 billion by 2025, and indeed $10 to $12 billion by 2030. So this is a growth story. This is about execution. This is about focus, and that's what we're set on doing.
Bernard, when it comes to the execution of your traders, you point out another exceptional quarter for gas trading, though softer than the first quarter. How much softer? What was the difference between these two quarters for your trading units?
Yeah, the trading organization in gas in particular had a very good quarter, an exceptional quarter as we called it. A little bit less than the first quarter, but still exceptional as we say. And it's really just a characterization of a slightly lower volatility in the markets in the second quarter than there was in the first quarter.
What's your outlook on demand on both oil and gas, particularly coming into winter? Are there any particular regions where you're kind of worried about the demand strength?
You know, I think there's a lot of talk, obviously, about concerns about the global economy. There's a lot of talk about concerns about China growth. In spite of all of these things, demand for oil has been incredibly resilient. In fact, there are some reports that say oil will reach its maximum demand ever this year. So we're expecting over 2 million barrels a day of growth in demand for oil this year, which is very strong when you look back in history. And we expect that demand growth to continue into next year.
Well, that was BP Chief Executive Bernard Looney speaking to, of course, our team this morning, Mark and Danny, on the company's outlook. BP is returning more cash to shareholders even as its second quarter profit fell by more than expected. And the other big story this morning was the RBA. If you look at what Aussie dollar is doing, we have it on the screen. Look, the Australian dollar really extended an intraday slide, falling some 1% after the RBA earlier this morning unexpectedly left the official cash rate unchanged at 4.1%. So that means traders are now paring bets on further tightening, seeing around a 40% chance for a hike by October. This is Bloomberg.
Manchester, not London.
is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Markets kick off August on a cautious note. Investors assess more lackluster data from China while the RBA keeps the door open to future hikes. Mixed earnings news. We've got a roundup of the latest results from big oil to autos and the world's largest distiller. And there's still more blockbuster earnings to come before the week is out. Plus, UK house prices are falling at the fastest pace since 2009. Details on that data amid the Bank of England's fight against inflation. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, happy August, the start to a new month, which seasonally usually isn't good for equities, but we are off the back of 5 consecutive months of gains for American equity.
Yeah, if the bulls were waiting for some sort of break in their winning streak, they might just have one this morning, Danny. Is that the start of that seasonal trend, though? That's still to be determined. Futures, though, they are in the red, and you're seeing them in the red by kind of a heavy margin, down about 0.3% earlier in the session by a bigger margin as well. So this is going to be a story of just how much momentum they can really keep as we get more of those earnings coming through. But I would argue a lot of this is sentiment as well. Sentiment coming out of Asia. We did have some not so great Chinese data as well, which really made the Chinese markets the underperformer of the region. So perhaps some of that seeping in through to the whole growth story of the entire world. The 10-year yield gets interesting, though, because technicals are playing a factor in the bond market. But I'd argue in the stock market as well. Round numbers are your friend, it seems like, when you're trying to roadmap where the markets are going next. For the futures, 4,600 seems to be that level. For the 10-year yield, it's 4%. So you're looking at 397 right now on that note, higher by just about 1 basis point. So no major movement just yet, but that could again change as we get more of those earnings, get closer and closer to those opening bells. But of course, overnight, the big story is going to be coming out of Australia. You are seeing the Reserve Bank of Australia essentially pause for a second time in a row. They're saying, look, a hike still might happen down the road as we talk about inflation. But if you look at what the analysts and economists are saying, they're saying, look, they've done it. They've won the battle of inflation. So the RBA is really effectively kind of front running what a lot of people expected the Federal Reserve to do. And that, of course, is creating some weakness there as well. You are also looking at, again, the Asia Pacific Index, on the other hand, rising simply because of that inverse kind of correlation. Essentially, the weakness you are seeing seeing in the rates market, perhaps giving a little bit of a tailwind there. And of course, we also have to keep in mind that they are also dealing, Danny, with that weaker Chinese data as well. A lot of exposure for the Australian economy there.
Yeah, the days of low volatility in FX markets, they really are far behind us. In Europe, we are seeing some of the pain filter through from the weak China data. One of the worst performing sectors is basic materials. That's where you see that will filter through. But what's really weighing down on a European index that on a headline basis is down 0.4% are autos. The worst performing sector, BMW, out with a trade update, a warning that supply chains are becoming more expensive for them. That's weighing on the sector as a whole. When it comes to FX this morning in Europe, it's all about that strong dollar. That seems to be the dominating theme. Euro versus the dollar weaker by about 0.2%. We're still under 110. We had some European data on manufacturing PMIs for Spain, Italy, and France, all of them still in contraction. We just also had some unemployment data that stays unchanged at 6.4%. And meanwhile, sterling credit, we're going to dive into the housing story. I know you got this one, but just pointing out that we are only slightly weaker at 128 on cable.
Certainly something to keep in mind, again, as we dive into the data. Danny, let's go right there. UK housing prices falling at the fastest pace since 2009. A jump in borrowing costs and the threat of worse to come is holding back demand from potential buyers. That's according to one of the UK's largest mortgage lenders. Joining us now is Bloomberg's Katie Linsell. Katie, how serious are a problem when it comes to those rising mortgage rates? We know the UK housing market functions a little bit differently than the way it does here in the States, but walk us through the ramifications.
Yes, I think really the focus now in terms of the UK's big fight against inflation is focusing on mortgages. You know, even if we look at the UK consumer having more strength in certain other areas, as long as mortgage rates are increasing, it's really going to be a burden on the consumer. And we've seen since late 2021 about 13 interest rate increases from the Bank of England. That's a sort of a continuous pressure on the consumer. And as we're seeing today, this really meaningful data in terms of house prices falling by the most since the financial crisis, it's really becoming a real burden on consumers. We also know that there is more pain to come. We've seen from Bloomberg Economics figures saying that they think house prices could have another 5.5% to fall. And the Bank of England is meeting on Thursday, and we could see another interest rate increase come through. So really the focus is shifting onto mortgages, and whether there can be any relief for consumers in the months or maybe year to come, it's still to be seen.
Is it coming in the form, that relief of shop prices, Katie, which, as you wrote about this morning, finally dropping for the first time in 2 years?
Yeah, that's an area where at least we can be a little bit more optimistic. So we're seeing shop prices across the board actually fell in July. It was a very small decline. It was only 0.1% of a decline. But that's still quite meaningful for consumers, because it's great when we can actually talk about prices falling rather than simply inflation easing. The key area where people are really looking there is food inflation. You know, that's the product that we all need to buy all the time. And there we've seen a decrease for 3 months in a row. We've seen inflation slowing. So that's really, really positive. And we're seeing food price inflation at the lowest level since December. Having said that, there are more burdens ahead in food supply chains, and we can expect global commodities to potentially increase. The focus there is on grain shipments from Ukraine, and how Russia pulling out of a recent agreement over grain shipments means there's going to be more pressure there, more pressure on rice exports also from India. So I'm afraid on food price inflation, we're not out of the woods, but there is at least some cause to be optimistic there.
Yeah, and perhaps something that the Bank of England comments on later this week as well. Katie Linsell, thank you as always. Of course, as we talk about the Bank of England and that higher rate dynamic to tackle the inflation dynamics Katie was just talking about, they're actually helping the banks. In fact, higher global interest rates boosted HSBC's profits. The bank beat analyst estimates for the second quarter with a bullish outlook for the year. CEO Noel Quinn spoke on Bloomberg earlier.
Those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth.
Bloomberg Finance editor Tom Metcalf joins us now. Tom, a really good set of results coming from HSBC. What drove them?
Yeah, well, look, it's really those rising interest rates. You know, we saw it's a net interest income story, really. And obviously, you just heard Noel Quinn talking about their strategy. But that really sort of, like for all banks, does depend on those interest rate rises. But yeah, no, pretty positive across the board, and obviously the buyback getting a lot of attention.
What about when you break it down by any line items? Any of those catch your eye, Tom?
Well, I was, scouring through it, seeing if there was sort of anything other than the sort of the good news story painted. I think largely, there's no great surprises in there. If you dig in a bit, they've got about $900 million of estimated credit losses, effectively charges against future loan losses. But that seems eminently reasonable. I'd probably point out the sort of Chinese real estate as probably the only area where perhaps there's some sort of hidden risks there.
All right, Tom, thank you very much for that update. That's Tom Metcalf from our finance team. Let's turn to oil now. BP raised its dividend by 10% and said it would buy back another $1.5 billion worth of shares, even as its second quarter profits fell by more than expected. I spoke to CEO Bernard Looney earlier today.
It's been a good quarter, and it's that performance and that outlook that has given the board the confidence to announce the $1.5 billion buyback this morning, and as you said, importantly, also increase the dividend by 10%. And that dividend increase of 10% is in part due to the fact that we've reduced our share count by 9% over the last 4 quarters. So we can essentially keep the dividend amount the same while increasing the dividend per share.
Let's dig more into these results. James Herron, Bloomberg European oil editor, joins us now. James, in speaking to Bernard Looney, they're really exuding this confidence and saying that's why we were able to give this shareholder return. But at the same time, their profits reflect what's happening in oil and gas at the moment. How do you weigh up those two for BP?
Well, I think that obviously there's been a big drop compared to the records last year, but the outlook, as the CEO said today, is actually quite good, especially for oil. He said demand is incredibly resilient, and of course OPEC is cutting production, and he sees stronger profits going into the coming months.
James, that really differs and diverges from what we're hearing from the likes of Chevron and Exxon here stateside, where they're actually perhaps pulling back on rewarding some of their shareholders. Why is BP so confident this is going to work in their favor in the long term, looking at those dividends and buybacks?
Well, I think that partly reflects the difference in position because, of course, BP was one of the companies that really cut its dividends during the pandemic. And so they're trying to persuade investors again that, yes, we can be a reliable source of cash returns. Even if there are the peaks and troughs of the oil market, you can rely on us to keep generating the yield. They're trying to win back a reputation that they used to have before the big dividend cuts in 2020.
James, thank you so much for that. That's James Herron off the back of those earnings, as you can see, moving shares higher by about 3%. All right, coming up, more earnings in focus. We're going to dig into Man Group's results. The world's largest listed hedge fund saw a pre-tax profit drop in the first half, even as assets under management surged to a record. And Diageo shares rise after the world's largest distiller said consumers remain resilient and that it's able to pass along price increases to consumers. More with that interview from Diageo CEO ahead.
We have been able to pass along the price increases that we needed to, but look, we are being very surgical about it. We're seeing inflation kind of moderate as we go forward.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Central Bank Palooza continues this week. Of course, we have the Bank of England later on, but overnight, getting some news out of Australia. They're pausing their rates for a second time in a row, really saying, look, perhaps the inflationary story is over for them. What's important to keep in mind, though, is you look at what economists and strategists are saying, it's simply that, well, maybe Australia actually won the fight on inflation. Another take, perhaps, they're so exposed to the Chinese growth story that as you see the Chinese data come in worse and worse, as we did, of course, overnight as well, that having a real read-through into the Australian economy as well. The question is, though, is if you start to see some of these rates kind of come down a little bit more and more, real rates are still in negative territory. Why pause now? And that's the question I'm going to put to a true expert. Bloomberg's Valerie Teitel joins us now. Valerie, your thoughts?
Look, Kriti, it's all about their forecast horizon from the RBA, a very subtle change from the RBA in that statement. They now declare inflation moving back to target within their forecast horizon, and that in central bank speak is the closest thing you're going to hear to mission accomplished from the RBA. They did still keep that threat of additional hike on the table. They still want to communicate they're in a hiking bias, but the fact that they are now seeing inflation falling back to 2 to 3% within their forecast horizon is great news for the RBA, and markets are jumping to conclusions here and think that the hiking cycle may be over.
It's not just for the RBA, though. To what degree do we look at this and say, globally, the hiking cycle, it's hit its end?
Look, Danny, it's all because we've gotten such good news on inflation recently. The RBA especially, they had the monthly CPI print last week, came in weak. And then 2 weeks ago, we got that real soft U.S. Data print. It's all about the trajectory of inflation for here. And if we keep seeing forecasts of inflation move further down, there's really no reason to keep hiking if you have that in mind, if you have that growth slowdown, that impulse then onto inflation slowing already in mind. So maybe it's too early for them to explicitly say mission accomplished, but the markets are sure trading that narrative.
What about today's data? JOLTS and ISM out of the U.S., is that going to add? Do we care about them? Could it change this narrative?
I'm going to be very interested in the ISM manufacturing data, and that's specifically because in the PMIs last week, manufacturing came in better than expected, right? I want to know if that's confirmed in the ISM surveys today, because again, that points to the fact that this U.S. economy, manufacturing, which was one kind of dim light in the U.S. economy, is seeing a rebound. A lot of that goes back to the enormous government spending we've seen from the various tax packages that the Biden administration has gone through. Do we see a bigger rebound in manufacturing going into Q3 and into Q4? And perhaps does that maybe delay this recession that we keep talking about? And I know that economists keep scrapping their views on.
Valerie, walk us through the market read through here when it comes to the dollar specifically. So many cross currents here. Overnight, one of the biggest movers of the dollar has been the Australian dollar, on the other hand. So interest rate differentials perhaps playing a role, but then you have data like the kind you just pointed out. What is driving the dollar right now?
Interest rate differentials were a big one overnight with the market repricing the trajectory of the RBA slightly. We're seeing that weakening in the Aussie. But look, the other one that's really driving markets at the moment is just this weakening we're seeing in yen. Yen is a very, very liquid pair when it comes to those popular dollar crosses we're seeing. And this weakening that we're seeing, it's now extending for 2 days in a row, maybe 3 days in a row after that Friday's shock yield curve control announcement. is the fact that the market is telling the BOJ, look, I don't think you've done enough on inflation, and because you're so hesitant to talk about this hiking cycle, you're really risking a weakening currency move. And I don't want to jump to too many conclusions, but Kriti, we're really not far away from the last time the MOF intervened in dollar yen. Remember, that was at a 144, 145 handle. We're just hovering shy of 143. So if this market narrative keeps pushing the BOJ to say, we want more, we want some more tightening, if they don't respond, you will see more weakening in the yen currency.
And we're not just at risk of that with Japanese data, are we? It's also the U.S. data. I mean, it's today's data, right? That could really challenge the BOJ if there's any move higher in yields globally.
Yeah, exactly. For instance, if we see a big strong a rebound in that ISM manufacturing print, if JOLT still shows a very tight labor market, and let's say we get a 10 basis point rise in those 10-year treasuries, what happens tomorrow morning when those JGB yields want to respond to global yields moving higher? Does the BOJ step in again? What kind of firepower are they going to have? And again, what is their tolerance for daily volatility? Because look, if you think about this scenario from here, it gets real bad for the Bank of Japan if the U.S. economy stays strong and if the Fed really does have to hold rates higher for longer. That is going to put a lot of pressure on this yield curve control tweak, a lot of pressure on more eyebrows being raised. Why aren't you raising rates, Japan? And maybe we'll see them being tested by the markets even more.
Yeah, last time they were happy to buy at 60 basis points. Maybe 70 is next. Maybe they keep going all the way up to 1%. Valerie, thank you so much for joining. As always, that's Bloomberg's Valerie Teitel. And for more market analysis, MLive Go is where you want to head on your terminal. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From New York City,
From London and Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside? on the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
It's funny, when people talk about this environment, it makes me think of the sort of old Looney Tunes cartoon where the character is sort of running above the air, and you're not quite sure if they'll sort of crash or if some sort of parachutes will appear and help them float. And the key word is uncertainty. That's what we hear. We hear with our clients. They're not sure how markets will react, and what we provide is firmly to address this uncertainty.
Man Group CFO Antoine Forterre there speaking on Bloomberg earlier. Kriti, you kind of got a feel for being a publicly listed hedge fund because they had a record AUM. They had inflows when there was doubts that they could get them, considering the hedge fund industry has been struggling as a whole. Yet shares are selling off this morning because the fees have been lower because the performance hasn't been as good. I also asked Antoine about that, and he basically just brushed it off, saying analysts just want to put a number inside of an Excel spreadsheet box. He literally said that. I'm not putting words in his mouth, and just saying, we don't care about the day-to-day movement.
Well, it's interesting the way that he's kind of talking about this, because essentially a lot of that is tied to their business model, and to some extent that is true. But then there's also this kind of macro theme as well. If you look at a lot of the banks that do have kind of these funds that operate underneath them, I'm thinking Morgan Stanley, for example, it's a similar dynamic, especially as you start to see, especially in the equity market, those incremental gains get smaller and smaller. You're not going to be making as much commission on those. So perhaps there's a macro read-through as well.
The good news, though, is that they're not losing investors, and that's really what Antoine there hung his hat up on. Now, a lot of earnings today, Kriti, and I also caught up with the new CEO of Diageo, Deborah Crew, and she started out by speaking to us about the U.S. market.
The American consumer has been pretty resilient. Our industry is very resilient. We're seeing growth for the industry back in the mid-single digits. Which that's really where it was pre-COVID and pre this kind of COVID super cycle. We are still seeing premiumization within the consumer. Prices, so what's driving the growth is really the super premium priced products. So things that are like $30 plus.
Now, Kriti, I also pressed her on pricing, whether they could continue to hike prices. She said that inflation is starting to come down. So I said, okay, do you need to keep hiking prices, and will consumers keep paying for it? She said, one, yes, consumers will keep paying up. And two, they're not going to rule out further price increases, which suggests that they likely will. I think this is interesting as we're trying to get a read on the American consumer. For those that drink premium brand whiskeys and alcohol in general, clearly there's resilience and they're willing to pay for it.
They are willing to pay for it unless the bottles are about more than $100, in which case you aren't seeing as much growth for that company as before. I think she mentioned that in the interview as well. Danny, I think what's interesting, though, is that a lot of companies, not just Diageo, are actually really testing the elasticity of the consumer. I wonder what happens when they hit that point that the consumer says, you know what, we're not going to pay this anymore. It's too much. And it's been, I'm going to say, at least a year and a half where we were expecting that to be on the horizon, and we still haven't hit that point. I wonder what happens to a lot of these corporate profits, a lot of the green on the screen we're seeing when we do.
You know what's sad? Their tequila couldn't keep up with the record growth they had. What are you drinking, Kriti? What's your drink of choice? Is it tequila?
At the moment, it's gin, but I have an issue in that there's so many different kinds of gin at the bar. When they ask you what kind of gin do you want, I don't have an answer. So I think I need like a proper gin tasting. Maybe you can set that up for me.
I see. We'll get you set up. We'll get some Tanqueray in there, some Bombay Sapphire. Hendrix, though, Kriti, is what you should be drinking, obviously. We'll give you a tasting when you're in London. All right, coming up, we're going to get back to the markets and speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. This is Bloomberg.
economics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Connection locked. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Markets kicking off August on a cautious note. Investors assessing more lackluster data from China while the RBA keeps the door open to future rate hikes. Plus mixed earnings news. We've got the roundup of the latest results from big oil to autos and, of course, the world's largest distiller. There's still even more blockbuster earnings to come before the week is out. And UK house prices are falling at the fastest pace since 2009. Details on that data amid the Bank of England's fight against inflation. I'm Kriti Gupta in New York with Danny Berger in London. Danny, it feels like earnings are really going to be driving the market, essentially a sum of all parts trade. But right now, not such great data coming out of Europe or China.
No, not great data. We had manufacturing PMIs coming out of a variety of regions, all of those still in contractions. Their earnings aren't great either, Kriti. They're uneven, but on a headline basis, at least as of the end of last week, we were looking at a majority of misses. When it comes to the European index, we're down about 0.5%. Some bad news from BMW on an expensive supply chain they're grappling with really seemed to drag this index further down because it brought the entirety of the auto sector down with it. China certainly not helping either. Basic resources, basic materials, those are moving lower in terms of that sector. Meanwhile, euro versus dollar, sterling versus dollar, all of them are fighting the strong greenback headwind as we prepare for a whole host of U.S. data we're going to be getting today. So maybe some of the bad data playing into euro weakness below 110. Sterling not doing as poorly. Two pieces of data we got today. Housing prices falling, but at the same time, shop prices are falling. That's good news for the consumer, a little bit of easing in inflation. So perhaps that's why we're seeing sterling not doing as badly in terms of performance against the dollar, Kriti.
Yeah, and that's going to be some sentiment that perhaps feeds the dollar as well. Danny, I want to get a quick check on what the U.S. side is doing as well, because you mentioned that cautious sentiment that you were seeing in European stocks. We're seeing a lot of that in futures as well here. Stateside, 4,600 right on the dot for those contracts, down about 0.3%. Those round numbers, they really matter, especially for the bond market, really kind of hitting that 4% level on the 10-year yield. 396 at the moment. Well, we are getting close. Again, the technicals playing in there. The dollar gets interesting, Danny. You mentioned the cable rate. I'm going to bring it back to the Aussie because, of course, we heard from the RBA overnight. They are pausing their interest rate hikes for a second time in a row. That weighing on the currency and giving, I think, a pretty big boost to the greenback this morning. Also getting a little bit of boost from China as well. That weaker data not playing in well to the offshore yuan. Dollar yuan, 717 there, stronger by about 0.4%. I want to come back to the equity markets, though, because overnight, a big call from a new bull on Wall Street. Oppenheimer coming out and raising their record year-end forecast for the S&P 500 to get this, 4,900. That's about 300 basis points higher. They write, quote, our price target assumes that the resilience exhibited by the U.S. economy will continue along with a high level of sensitivity by the Federal Reserve in raising its benchmark rates further. Essentially, stocks higher because rates lower. And that's actually a sentiment that David Costin over at Goldman Sachs shared as well. Let's bring in an expert, someone who has a ton of experience in the stock market. Jay Woods, Chief Global Strategist at Freedom Capital Markets, joins me right here on set. All right, when we talk about upside in this market, everyone has seemed to turn the tide a little bit, and yet we're going into 2 months that are seasonally known as a little choppy for the equity market. What side of this do you stand on?
Well, I welcome the new bulls to the party. It's been going on for a little while, so it's nice to see those. Yes, seasonal headwinds are a major factor. August, September, the last 20 years have been, they've been exciting. I know last time I was on, Danny complained the market wasn't exciting, and I called for a boring uptrend. I think no 1% drawdowns in 2 months. So yeah, that's boring. But bull markets tend to be that way. And any of these new calls I think are smart. The next 2 months could be choppy. We draw back down 5% in the S&P 500. That happens on average about 3 times a year. That brings us to the 50-day rising moving average. So as a technician, that's a healthy pullback. And then we go into the last quarter, which seasonally and in an election year or pre-election year, it tends to be one of the strongest. So I think the momentum continues into year end, and I think that's a great call. Yeah, a lot of tailwinds for the S&P 500. But let's talk about breadth here, because that's been the issue when we first started seeing a little bit of the positivity. For me, when I look at breadth, I look at, does the Russell and the NASDAQ, are they both moving in the same direction? If they are, it means there's momentum to this breadth. Talk to us a little bit about the Russell, though, because it hasn't really recovered back to where it used to be. Well, they finally are all moving in the same direction. The NASDAQ, some of the leaders are pausing a little bit, and that's healthy. And what we've talked about many times is rotation. And now we're seeing it in the Russell 2000, the small cap index. People are chasing performance. People are looking where you can find some, nice upside. If you look at the drawdown from the peak in the Russell, we can still go up 19% before we hit 50 all-time highs. So this 2000 level, yes, it sounds psychologically nice. You probably get a nice hat if you're at the floor of the New York Stock Exchange to celebrate. But no, this is just a breakout, and we should see continued momentum. It has a nice long base, consistent higher lows, and now we're seeing momentum into it. So this to me is just more continuation of a revolving bull market.
I used to have a Dow 20,000 hat at one point, and I gave it away as a gift to my stock market editor in the U.S., and I still regret it to this day, Jay. If you ever come across one, hand it to me. I'll look like an Uber bear if I wear it, so that's a cool thing. Jay, when it comes to energy stocks, the energy ETF, XLE, it's up about 7.5% on the month. For the entirety of the year, a little bit less than that. But it is crude's best month since January 2022. Does that trend continue? Does the market, in terms of stocks, also need to play catch-up?
Yeah, this is one sector. The XLE, the energy sector, was the leading sector 2 years in a row, and it was lagging, and you got the rotation into tech. It was a sector, to me, that looked very toppy, but we're seeing resilience in the XLE when 39% of that index is 2 stocks, Chevron and ExxonMobil, and they're just starting to make moves. Chevron got a great upgrade yesterday. I believe it was from Goldman Sachs, and ExxonMobil has been starting to run. They're both heading towards that 200-day moving average. They're both in a nice little consolidating zone, but they can't break down. They never did. And now watch crude. Crude at 83.5. If we can get there and break above it, you should see a run to 85.90, and it could happen quickly. So there's some action for you. And this is a sector that, people may chase into because it's underperformed the rest of the market.
Jay, the most read story on the terminal this morning is data from the prime brokerage services of both Goldman Sachs and JP Morgan that hedge funds have degrossed. They've taken profits both on the long and losses on the short end and just gotten closer down to the ground. When you look at something like that, is that a good thing? Does that mean there's more firepower to keep this market going? Or if hedge funds are turning cautious, do you want to turn cautious too?
Well, maybe they're turning cautious because of those seasonal headwinds, but no, I think it's a good thing. I think people are ready to, one, they have to play catch up. If you weren't in you know, some of those top 7 stocks in the first half of the year. Now you got to find, where can I get that kind of performance? The stocks that can rebound, the stocks that have been beaten down the most, are starting to lift their heads. There's so many nice long bases that, as a technician, you want to see start to turn, and you can get quick gains like you saw on a Roku or a Coinbase, or most of the stocks in the ARK fund for that matter. So when you hear that there's, you know, some readjusting, I think they're positioning themselves. They're getting ready to chase a little bit, and it should make for a strong end of the year.
All right, Jay, poke holes in your own theory for us. Where are the risks that you think that could undermine all of this positivity, completely turn the tide and reverse, I think, the almost 30% gains we're seeing?
Yeah, well, the Fed is always a risk, but then when Neil Kashkari comes out, one of the most hawkish Fed governors, and says that the soft landing is approaching, it kind of took me by surprise. When everyone gets on this bullish kick, then I'm going to be a little concerned. When sentiment goes through the roof, I'll be a little concerned. Economically wise, things have been going okay. I'm trying to poke holes in it all the time, but we're still seeing that slow, steady rotation that you want to see. Jackson Hole's coming up. I believe it's August 25th, 26th. Last year, if you recall, that was not a very good time for the market. That was our top. I don't think Powell's going to put a little cold water on our recent rally this time like he did last time. Yeah. But that's something I watch. And then September, historically, you know, people think October because of the big crashes. And I've heard, oh, well, the Dow was up 13 days in a row in 1987, just like we were now. So maybe that's a sign of things to come. But outside of a black swan event, you know, a Taiwan event, that we really don't like to predict, or we're not in the game of predicting. Yeah. I'm going to continue to follow the trend, and I'll let you know when there are holes to poke. But right now, it's slow and steady again, but I still think, Danny, we see some action in the coming months.
Yeah, we'll definitely bring you back to do that. Talk to us a little bit about the earnings picture as well. Danny and I have been covering the earnings story all morning. Yeah. And one of the consistencies you're seeing on both sides of the Atlantic is simply this idea that price hikes are still digestible by consumers around the world. But at some point, that's going to stop. Do you then see a massive wave of, I want to say, kind of punishing some of these corporate companies who have been able to push those price hikes through? Well,
you're talking about some of the discretionary. You want to talk earnings? Let's talk about Starbucks, to me, an international brand. I was just in London, and you know, it's a little more expensive over there. They're a little slower there too when they you know, serve you. But their earnings are out after the bell today, and technically, you have what some may say looks like a Head and Shoulders top. It's a little ugly, but it's at an inflection point. It's at the 200-day moving average. And you talk about headwinds. You have student debt coming back. And now I kind of have my pulse on those college students having that. I have 3 of them. And, you know, where are they going to cut back? You know, maybe they're going to finally realize that Starbucks is, you know, something that we have to pull back on. And then with Starbucks, you always have to watch their numbers out of China. And then coffee, it's starting to bottom and tick up. So will they be able to absorb that, pass it on to the consumer? I think the consumer may pull back when the student debt payments start at the end of September, beginning of October.
Yeah, and reporting those earnings after the bell, Jay Woods, we thank you as always. Of course, hear that, Starbucks? Jay wants better service in London. He joins us.
We like to pretend
always.
we're Italian here, Critty. We like to pretend we're Italian, slow service, that kind of vibe.
Don't let Francine Lacqua hear you say that. Like, she's coming for you.
No, she'd be mad at me.
Coming up on the show, we're going to get a check on autos as BMW warns that higher supply chain costs will weigh on cash flow this year. Stick with us. This is Bloomberg.
For the first, you know, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Shares of BMW are falling this morning after warning of higher costs for developing EVs and stocking up on parts in a difficult supply chain environment. Joining us now is Bloomberg's Oliver Crook. Clearly the market doesn't like this one, Oliver. BMW sold off really steadily after the announcement. What exactly is giving them such a headache?
Yeah, I mean, the numbers themselves were basically in line with estimates, and in fact, they felt comfortable enough to raise their forecast, and also they did better on margins, and they raised their forecast for margins. However, investors are looking a little further into the future. As you say, they're concerned about some of the comments they made about how much it's going to cost to develop the EVs for BMW. They're saying it's going to cost more, that there might be some supply chain issues again in the back half of the year. You know, VW flagged some logistics issues. They had to reduce the number of car deliveries that they're going to have this year as a result of that. Porsche saying that they weren't going to be able to get all of the parts for their EVs. So really this is, and Stellantis even worrying about the chip supply. So we're down, what, about 6-7% this morning on BMW, still up about 25% this year. What they didn't update on the pre-release, however, Danny, was how many cars that they had on that ship that was burning off of the Netherlands. That is what I'm watching for. They said maybe a couple hundred, but that could be in the thousands. It could be, 200.
Ollie, you've been talking a lot about the German car makers. Let's go internationally here. How does it compare to the earnings we got out of Toyota, for example?
Yes, so Toyota, we don't talk really nearly enough about. It's still the biggest car maker in the world, really pulled ahead of Volkswagen in terms of number of deliveries. They beat on profit. They've done they had the best month of June in terms of manufacturing and sales on record. They are saying that their semiconductor supply situation is looking good, and the weaker yen helped them critically. 76% of their sales are done overseas, so that has been a big part. They're being conservative, however, they're not raising their outlook or anything like that. Their shares rose to a record over in Japan today, and really echoing some of the positivity we've had out of the auto sector here in Europe.
Elsewhere in the auto sector, specifically with EVs, people familiar telling Bloomberg that Exxon is in talks with Tesla, Ford, VW on supplying lithium. This is an interesting development, Oliver. I mean, is it just Exxon tying their fortune to what is a strong EV market?
I would say so. I mean, listen, this is the holy grail. This is lithium here. This is what is going to fund and, power. Yeah, this is pretty exciting. This is spodumene. This is not the kind that they're going to be extracting. Exxon is looking to extract brine, so salt underground water, lithium from underground and take it out. They say they've got synergies with their drilling business, even their refining business, and so potentially they could benefit from that. If you look at the price of lithium, it rallied about 1,100% from 2021 to the peak, now up about 400%. And you can understand why Exxon wants a piece of the action. So what we know from people familiar, they're in talks with, as you say, Tesla, Volkswagen, and Ford. They're setting a goal of 100,000 tons of lithium a year, and they've already picked up some acreage over in Arkansas where they're starting to apparently begin to explore this. So still early days, but they want a piece of the action.
Bloomberg's Oliver Crook covering all the automakers and having his Bill Nye moment on Bloomberg Television as well. We thank you as always. Coming up, we stick with the earnings story. Caterpillar earnings out in less than an hour. We're going to get a closer look next. This is Bloomberg.
what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Let's get you set up for your day and take a look at what's ahead. 9:45 a.m. Eastern, we're going to get U.S. manufacturing PMI. It's been strong thanks to the Inflation Reduction Act. Will that continue? It will be followed by JOLT job data. That will be at 10 a.m. Eastern time. Plus, we're also going to hear from the Chicago Fed President Austin Goolsbee. And among the many companies reporting, Kriti, we're going to get Uber, Merck, Pfizer, Marriott, Starbucks, and Caterpillar, one we have our eye on, reporting within the next hour.
Well, let's start there, Danny, because, of course, we know of Caterpillar as kind of this global bellwether that a lot of people look at. Demand for their iconic excavators also going to be in focus for investors. Let's bring in a true expert. Bloomberg Intelligence industrials analyst Christopher Cellino joins us on Bloomberg Television this morning. Thank you for waking up bright and early for us. I'm sure it wasn't for the earnings, definitely for us. But walk us through kind of this idea of it being a global bellwether. We had DHL, for example, report in the European session as well. They're talking about not beating to the extent that the market thought that they would. When you're talking about CAT in terms of the kind of global economy, what are you looking for? What's your kind of canary in the coal mine there?
Yeah, so CAT, obviously the largest construction equipment manufacturer, touches a lot of different end markets and regions globally. So I mean, we expect CAT to put up another real solid quarter, maybe not as strong as 1Q, but still anticipate very strong operating performance as really customer demand across most of its end markets remains generally healthy. We'd expect pretty sizable year-over-year margin improvement across all of its core businesses on what is still a really favorable pricing environment, healthy volume growth, and improved manufacturing efficiencies as the supply chain continues to normalize here.
What about demand in Asia and in particular China, Chris? How big of a drag might that be when they report?
China's going to be weak, and we saw it take another kind of leg down here in the quarter. If you think about China, historically it's been about 5 to 10% of consolidated revenue at Caterpillar, but just given some of the weakness in the market over the past few years, it's even going to be below 5% of total sales this year. I would anticipate that they'll be pretty cautious on China and the outlook for the rest of this year, but would anticipate some sort of rebound starting to materialize into 2024.
Chris, talk to us a little bit about the backlog here, the order flow. What is Caterpillar seeing in terms of whether they can actually meet the capacity that they're perhaps being dealt with?
Yeah, so I think this is actually going to be the bigger question, and really the focus when they report earnings is really going to be the sustainability of this level of performance, as we kind of appear to be approaching a peak in the cycle. So
Orders inflected for the first time in 2+ years last quarter. Backlog has probably peaked, and dealers are expected to reduce inventory levels over the balance of the year. So there's a number of signs that would seem to suggest a coming slowdown. So that's certainly going to be in focus when they report this morning.
Is this a normal cycle, though, Chris, when you've had this huge boost to construction thanks to the Inflation Reduction Act?
No, not a normal cycle by any stretch. As you mentioned, we have an immense amount of fiscal stimulus coming through the pipe here. So I think, that you're probably looking at a more resilient CAT through this next downturn because of the immense amount of fiscal spending. We're really not seeing signs of customers in financial distress. So, they're in financially healthier position compared to prior slowdowns. And the services business has grown quite a bit. That's a larger portion of the overall business and very profitable. So that tends to be a little bit more durable in downturns. So I think Caterpillar will certainly hold up better and post probably better decrementals than what we've seen in prior cycles.
Well, let's see if the stock reflects that. At the moment, we're seeing Caterpillar shares down about 0.4%. Christopher Cellino of Bloomberg Intelligence all over that story for us. Of course, we do expect those earnings coming at about 6:30 a.m. New York time. Let's take a look at some of the other stocks we're watching in pre-market trading. Tesla at the top of that docket, potentially cutting prices on some of their Model 3, Model Y vehicles in Hong Kong. That coming from Reuters, citing the Hong Kong Economic Times. And remember, it's not China, because Tesla had signed on to that price kind of packed with a lot of the EV makers there. This is specifically for Hong Kong, pulling those shares down by 0.8%. A big part of the tech story has also been jobs, simply, which brings us to Alphabet shares. Those down by about 0.6%. Reports that they're going to eliminate some jobs in the assistant overhaul coming from Axios as well. In a similar vein, CVS also looking to cut about 5,000 jobs in their cost reduction push, according to the Wall Street Journal. Those shares higher by about 1.5%. So some interesting mixed pictures about whether or not that's viewed as a positive thing, Danny. And of course, earnings season continues. Stateside, we've got Merck, Pfizer, Uber, and Norwegian Cruise Lines, and those are just some of the names for the opening bell. You are seeing a lot of green on screen for all four companies, Danny.
Fortunes are certainly different for Europe, Critty. As we've been speaking, we're looking at European big cap stocks. The Europe Stocks 50 plumbed the lows of the session. It's down more than 1%. That's the top of the board there. What is moving that? It is LVMH, perhaps some China weakness, and BMW. We're just talking to our reporter Oliver on that, concerns about the supply chain. But those are the big weights on here, pulling everything down. Aussie dollar also at the weakest of the session after the RBA, Critty, decided to hold rates, saying, hey, more hikes might be coming. But we're clearly getting a big positioning shift rather, as traders bet this is it. This is the end of rate hikes, at least for the RBA.
Yeah, and that sentiment really seeping into U.S. as well. That does it for early edition. Surveillance is ahead. Tom, John, Lisa, take it from here. This is Bloomberg.
Get a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
This is Bloomberg.
People are really reacting to pieces of data that confirm the soft landing.
The market is broadening. It's moving into other more value-oriented parts of the market.
I mean, the big tech has clearly done a lot of impressive lifting here.
I do think the market's a few points overvalued.
I do think our prospects are good long run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. TK taking a break today. Your equity market just a little softer, down 1/3% on the S&P 500. The headline of the past 24 hours, the bulls on Wall Street getting a whole lot more bullish. Let's start with Oppenheimer's John Stolfus, now looking for, on the S&P 500, 4,900 from 4,400. Credit to him, that 4,400 price target, Lisa, set at the end of December. So he was bullish and right to be bullish, and he raises his price target. Citi are now looking for 5,000 by the middle of next year. So it's record high watch on the street now.
It's record high watch, and the potential for, if you believe John Stolfus, a 28% gain for this year, which means that it would be the biggest gain going back to 2019. And here's the real issue. Can we get the start of a new bull market given some of the increase in credit contraction, some of the softening that we see in economic indicators? Could this still be the start of a new bull market, as many people are calling for?
I love what Citi's Scott Cronin had to say. He said, clearly we're chasing the tape, just acknowledging it straight off the bat. Went on to say this, though. Growing conviction in next year's earnings acceleration is a key point of differentiation. So he's looking for earnings to accelerate into 2024.
One of the key underpinnings for a lot of these bets, and I'm not speaking to Scott Cronin, but more broadly, is that eventually the softness will cause the Fed to pivot, which will sort of turbocharge the rally that we've already seen, including some of the earnings, because then all of a sudden borrowing costs will drop. This is the big bet that gets people to continue to buy into equities, and then you have all the people saying, isn't this what we've heard before? How do we get tightening credit standards to this degree without a recession, without something more substantial, a little more pain?
Capital economics were talking about that yesterday, given the degree of tightening we've seen in credit standards. We've seen it again. We saw it in the latest report just yesterday, Lisa. Demand for loans a little lighter, credit standards tightening just a little bit more. But it's not what we expected coming out of the banking malaise of, say, 3 months ago. We thought it would be drastic, faster, harder, and it's been slow, and it's just continued at a steady pace.
I was thinking about this last night. Does it matter if it's slow and steady versus sudden and a break in credit creation? In the past, it hasn't mattered. Each of the 4 times since this index was created, every time of tightening in credit conditions like the one that we're seeing right now has led to a recession every single time. So is this time different? Can you put a bet, a strong bet on this time is different? a lot of people are saying yes. And that, I think, is interesting because everyone always used to say those are the most dangerous words in all of finance.
5 months of gains on the S&P 500. The gains continued through the month of July. Your equity market this morning, and good morning to you, just a little lighter, softer, negative down on the S&P 500 by, let's call it, 1/4%. Yields basically unchanged. Your 10-year 396. Going into a ton of data a little bit later. The dollar stronger. A break of 110 here on the euro. 109.76 on that currency pair, Lisa. Negative here by 0.2%.
And we're going to be speaking with Jordan Rochester later on, who has an interesting call on the euro. Today, when you talk about the data, 10 a.m., U.S. JOLTS data come out. The job openings, which a lot of people say might not be all that reflective of just where we are with 2 job openings or almost that per each employed American, unemployed American. We're looking at the potential for a loosening market, which is what people want to see. We also get ISM manufacturing data, which I know you'll be looking at very closely, especially what we've seen in China and Europe, which is manufacturing recession ongoing. 10 a.m. also, Fed speak includes Chicago Fed President Austin Goolsbee. He sounded pretty close to declaring victory yesterday. He was speaking with Yahoo Finance, and he said that the soft landing is this golden path that would be a triumph and is certainly a possibility at this point, basically talking about possibly not raising rates.
Hasn't made his mind up about September.
Yeah.
Speaking of Yahoo, I thought that was maybe the headline for me, that someone as dovish as Austin Goolsbee hasn't made up his mind for September. Now, whether you believe him or not, I guess it's a separate thing.
That was where I was going to go.
Clearly, they want to make you believe that the September meeting is live and the data between now and then matters.
Well, I think that that's the point that really gets hammered home. I think a lot of people are leaning towards September a pause at this point. But the Fed doesn't want to say that because they don't want to give the all-clear kind of signal. Today, when it comes to how long the consumer can keep spending, we're getting a number of earnings. Before market, Uber, Marriott, JetBlue, and Norwegian Cruise Lines for all the cruisers out there. After the bell, we get Caesars Entertainment and Starbucks. We also get Pinterest and AMD. But the year-to-date gains have just been stunning. And yes, it's a recovery trade, but Uber shares basically doubling this year. Norwegian Cruise Line up 80%, Marriott up 36%. How long can people still do the YOLO? The, FOMO, YOLO, and post-pandemic revenge travel.
See how expensive Uber is in New York City now?
It has doubled, at least.
It's insane.
Yeah, and so you think about that, how long are people going to say okay to that and still order their salads and get it delivered by Uber?
I'm flagging yellow cabs now on a daily basis.
Really?
Seriously.
Really?
Seriously.
Okay.
You will see me in Midtown flagging a yellow cab.
But the quality is different because the whole ecosystem has changed. Have you noticed that?
What, you mean the yellow cabs are better?
No, I think that it's different because the Uber drivers are more distinguishing with respect to who they take or they don't because of the rating system, and the yellow cabs don't. So there's sort of a harsher tone, I feel like.
You mean the quality of the Uber is better?
Yeah, and just in general, the stories from the driver. Okay. It's a more hardened experience in the yellow cab.
You've got a good rating, right?
Yes, I do.
A 5.00?
Not anymore.
No, has it come down?
It did go down.
What's it come down to?
4.96.
Oh, same as me. There we go.
Okay.
There we go. That's good. Good benchmark.
I'm glad. I can't believe I feel so seen.
One day I'll share with you TK's
Oh, yeah. I don't even want to know that. Actually, I really do.
You can find out a lot about someone based on what their Uber rating is. We'll talk about that another time. Patrick Armstrong joins us now, CIO of Plurimi Wealth. Patrick, wonderful to catch up with you. We get these notes on a daily basis on our guests, and there was this line from you that just made me laugh. We continue to own tech and communication stocks, brackets, thank God. And Patrick, I think a lot of people might feel like that if they have been in tech so far year to date. There is this feeling more recently that it's time to shift, get away from the big winners. Patrick, what are your core holdings in technology in the United States still?
So I own Apple, I own Google, I own Adobe, Fortinet. So I've got a lot of them. Pretty much a market weight. None of them are cheap anymore. They're all expensive. I'm not planning to be selling them. Probably the biggest mistake I made over the last decade was selling these kind of stocks when they hit 30 times earnings in 2018 and 2019. They moved much higher after the sell-off then. So you can see a lot of scenarios where they stay at elevated multiples. These are companies with dominant market shares, producing above average growth. Definitely not cheap. Fresh money coming in today, I'd probably rather be selling puts on them, to be honest, rather than buying them outright. So just betting against a massive downside, and that would create a forced discipline of buying them on a sell-off. But those are the kind of stocks that are driving my portfolio this year. I've got a market weight, but they are expensive.
Well, they've done well, that's for sure. Double-digit gains almost across the board. Patrick, there is this talk, of course, and I mentioned it, about rotating away from some of those winners towards, say, energy and banks. Banks had a wonderful month through July. Patrick, what would fund that move into energy, which you're looking for outperformance from? I think we may have lost Patrick Armstrong there, unfortunately. So that's a good start to this morning. Patrick Armstrong of Plurimi Wealth. He's had a great year, hasn't he?
Yeah.
Think about some of those core tech holdings that we've had so far year to date from him. And also rotating out of some of the winners over in Europe, LVMH. I remember when he came on this program and made that call. That's a decision we've all got to make, right? If you have been in tech, do you want to stay with tech? And to Patrick's point, I think there's so many people out there like him who have sold those names and then regretted it later, given the performance of the last 10 years.
There is a feeling, though, of arbitrariness to some of these calls, just because there is acknowledgement that everyone's riding momentum. I mean, I'm even looking at Patrick's comments in his own notes. We continue to own tech and communication stocks. Thank God, right? I mean, there is this feeling right now where it's almost up to luck or getting a sense of what the zeitgeist is, to use Tom's word, or to go with the flow and look for the tea leaves for when to get out. So these are some of the things that people are talking about at a time when the skeptics are getting smaller and quieter. But they're saying, really? Is this really going to sustain a rally that much?
You can't believe it's August already. Just to work through July and talk about some of the winners. I was going through the year-to-date gains and the monthly gains. Let's start with the monthly gains. 5th month of gains on the S&P 500. 3% gain in July. Longest monthly winning streak now on the S&P, going back to 2021. Had some slight outperformance on the NASDAQ. I know that changed towards the end of the month, but the NASDAQ outperformance on the month, the NASDAQ was up by close to 4%, but the standout winners, small caps, up 6%. Banks on the S&P 500 up by 10%. We have left March way behind and moved on pretty quickly, Lisa.
And the story that I think is the sleeper story that will come to the fore is oil. It has been a massive gain in oil. We've seen the biggest gain going back to January of last year in terms of a monthly basis. At what point does this start to bite a little bit more as people talk about the tightness in this market and the fact that it might have been distorted by people not wanting to own physical oil because it actually costs something, opportunity cost of not putting your money in a money market fund?
I'm pleased we've reestablished the connection with Patrick Armstrong of Plurimi Wealth, who joins us over the phone. Patrick, I wanted to squeeze in that extra question, and my apologies for the technical problems. You're funding that move towards energy. Can you just explain where that money's coming from? If you're not trimming tech, what are you trimming?
Well, I'm letting tech run, but I've actually been overweight oil all year, so it's not been a good call for me, but they are compelling valuations. There's been more oil consumed today than there ever has in the history of the world, and oil companies are down year to date. They're producing massive cash flow. They're buying back shares. They're paying dividends. They don't have the debt issues of the past. And with OPEC showing an inclination to cut on any weakness in oil prices, I do think we've got pretty oil prices that are going to stay sticky at these levels with upside if we ever get to Asia and China really performing the way people were expecting earlier in the year.
Is it consistent to see oil prices continue to rise and the rally that we've seen more broadly continue, right? I mean, is there basically a reason behind some of the decline in oil prices that have fueled the soft landing story that has underpinned some of the gains in the other sectors of the equity market?
I think that's part of it. So you've probably had a little bit better margins across industrials, airlines, companies as oil prices did sell off. But I don't think oil prices at $80 a barrel are really going to change the profit outlook. If you did see a spike in oil based on some exogenous events, that would obviously impact margins in other sectors. But oil prices gradually moving higher, staying sticky at these levels, create great profits for oil companies. But I don't think it's going to create a significant headwind in margins in other sectors.
How long can you ride momentum, Patrick?
Yeah, so I'm thinking about it. I'm sticking with the momentum that I've got in the portfolio. But they're not at ridiculous valuations, the companies that I own, but they're not cheap anymore. I actually bought Adobe in March, and it was trading at 24 times earnings, which was a premium to the market, but now we're up in the high 40s times earnings. Apple was 20 times earnings in October. We're up to 30 times earnings. So if they do have another significant run-up that's driven on multiple expansion, I'm going to have to start to trim them on valuation measures. I won't cut them completely, but we are in the final innings of a multiple expansion rally in these stocks. You'll have to see real revenue growth rather than just prospects of growth for me to continue to own them.
Lisa alluded to it. It feels like we've been in that final innings for the last 5 months, something like that. Patrick, thanks for jumping on the phone and making this happen. Patrick Armstrong there of Plurimi Wealth. You can just sort of copy and paste these worries, these comments about this market being too extended through the whole of the past, I would say 3-4 months. Even
with the argument that it's been all multiple expansion and not underlying revenue growth. I mean, that's the same argument people have been making for a while, and yet things have continued to melt up, which is a reason why a number of people have just come out and said, you know what, we're going to go with it, because why are you going to fight this? I mean, we heard this yesterday from Michael Purvis. Look at these charts; they look really good. The charts is how can you short this chart? You know, and then all the people are saying, well, you know, fundamentals at some point will matter, but not for a while. So make hay while the sun's shining.
I have great respect for the technicals and those kind of people who can just say, I'm buying the chart. It's like, does it matter what's on the chart? It just I've always struggled with that. I've always struggled with that.
I have too, and I've been wrong. I mean, that's the thing, is that I'll just admit it. When I start to overthink all of the details and the potential risks, I've been getting it wrong in terms of my expectation of what's going to happen. So do you just ignore your instincts, you ignore your skeptic, your inner skeptic, and go with the flow? And at what point does that lead to the next turn in the cycle?
That's where the gains of the last decade have been. Just sort of ignore your doubts and hold your nose, shut your eyes.
I know.
And keep buying. This year, a great example of that to some extent. We'll talk about energy a little bit later. Capital returns from BP, following the likes of Shell, Total, Exxon, and Chevron. All of that coming up with Elise Ossenbar of JP Morgan Global Wealth Management. Your equity market just a little lighter this morning from New York City. Good morning.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg Sonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
The market is broadening. It's moving into other more value-oriented parts of the market. The names that have not been bid up are starting to participate more. It's about avoiding the euphoria and looking at the true fundamentals. Personally, I think yields start to come down over time. Right now, this is a market that is feeling like a recovery trade. It's probably not the recovery trade.
Brian Levitt, Global Market Strategist at Invesco. Credit to the people who got this market right. Brian's one of them so far in 2023. Another one is John Stolfus of Oppenheimer, who's now looking for something close to 5,000 on the S&P 500 by year end. Citi now looking for that by mid-year next year. They're also looking for an earnings growth re-acceleration as well. So the bulls in the last 24 hours getting more bullish, it seems. In the equity market at the moment on the S&P 500, we are negative on the S&P. We're softer. We're down by, let's call it, 1/3%. No real drama here. Captured in the bond market by not doing much at all on a 10-year at 396.49 in the FX market. A euro just a bit weaker here by 1/4% on the euro side of things, 109.70. Just a brief quick look at the pound. Pound sterling cable 128. So that's the pound against the US dollar, 128.11. We're negative by 0.2%. Lisa, a little bit later this morning, you and I are going to talk about home price in the UK in about 10 minutes time. So we'll save that conversation. But the Bank of England coming up later this week. And Kit Jukes of SocGen basically saying sterling's vulnerable if the Bank of England doesn't hike by 50. There was some speculation that maybe the next move would be 50. I think that's died down a bit, and we're now looking for 25.
And it's because inflation has surprised to the upside. If you look at mainland Europe, you are seeing it also surprised to the upside. There are all of these labor issues and concerns about how much wages are increasing in London, in the UK more broadly. So at what point is this a credibility issue? At what point do markets start really pushing back against how much conviction some of these central bankers actually have about fighting inflation versus trying to avoid some sort of hard landing?
Based on the communication from the ECB and the Federal Reserve in the last week, I don't think they've got any conviction about anything.
Correct.
The hawks, the doves, none of them seem to know what's coming in September. Pick a hawk on the Governing Council of the ECB right now, can't commit to September. Pick a dove on the Federal Reserve right now, can't commit to September. None of them seem to commit to anything at the moment through the next month.
Have you noticed that markets have stopped caring? That a lot of people who we talk to say, I'm so sick of this conversation. Honestly, we're in charge. The data's in charge. We can interpret the data. They're going to follow us. They no longer are trying to tamp down some of the animal spirits that might be coming up. It's no longer a concern for them. That seems to be the feeling because the Fed as a risk case doesn't seem to be anywhere in these notes that are upgrading the forecasts for S&P targets.
Sanofi Desire is one of them over at Franklin Templeton, who was just like about time. The central bank haters, or rather I would say the haters of central bank activism of the last 10 years, just want them to stay at 5 and go away. Just sort of go away and disappear and let things function, if they do function. Jordan Rochester joins us now, G10 FX strategist over at Nomura. Jordan, wonderful to catch up with you, sir. Let's start with the Bank of England later this week. Is it 25? Is it 50? Is it what the ECB and the Federal Reserve delivered over the last week, which is a lot of communication about a ton of nothing? What is it?
A ton of nothing. Well, in terms of the Bank of England, we think they'll do 25. And the problem, John, for sterling is that there's about 32.5 basis points priced for that meeting. And that's going to move sterling. Now, it's not too much. It's not like a 50-50 chance of them going for a 50 basis point hike at this meeting priced in. But you saw with the RBA overnight, when there's around 8 basis points or so priced in for potential hike and they don't deliver, it can see a big move lower in the currency. So it could be the case that on Thursday we have Bank of England doing 25. It's too early for them to declare a victory lap. That's the thing. So we think there's going to be another few more hikes to come, maybe 75 basis points overall from where we are now today, this year. And that's the reason why sterling has relatively traded quite well. It's become a carry trade, John. It's one of the highest carry currencies in the G10. But all the charts we follow that tell us where inflation's going say it's going to slow down quite noticeably. So the good sector, John, really going to slow down. Disinflation is here. The problem with the UK was services inflation. Our indicators suggested it should have gone down starting around a few months ago, and it didn't. But the good news is the last CPI print was possibly the peak of service inflation in the UK. That's why the Bank of England might take note of that and say, actually, there's some early signs that policy is working to slow down that sector. But it's just one data point. We need a few more CPI reports until that victory lap can be declared.
On this side of the Atlantic, we've had a similar conversation about whether the Federal Reserve is sufficiently restrictive. When you put everything together that you've just said, Jordan, can you draw that conclusion that the Bank of England is sufficiently restrictive?
I think they are, John. We're seeing evidence in terms of PMI input prices, supply side, all saying it's restrictive. Demand is slowing down, retail sales. All these sort of indicators are nowhere near as strong as what they were last year. But a lot of the analysis that goes into it sometimes just proves wrong in terms of the hard data. So the PMIs have been very weak on the manufacturing sector, but the industrial production figures haven't been as weak. The soft versus hard debate. So if you're looking at hard data, you're looking at realized inflation, you're the Bank of England saying we need to do more. But if you're in my space, if you're looking at the forward-looking indicators, they suggest, yeah, we are pretty close to being sufficiently restrictive.
That's over in England, where John was mentioning UK housing prices, which dropped the most since 2009, as you do see these rate increases, and we will talk about that later. Over in Europe, in the European Union, there is a question around whether they are sufficiently restrictive at a time when core inflation has exceeded headline CPI, the most going back to 2021, and at a time when you're starting to hear a little bit more of a dovish conversation from some of the members there. Can you still get bullish and long euro versus dollar if you do have that kind of shift even among the hawks?
Indeed, we've had a shift already, and that's kind of why euro-dollar has really fallen from the 112 handle to where we are today, just below 110. We've had various moments this year where it felt like euro-dollar might break to the upside and to the downside, but the pain has been this range that we've had for most of 2023. We need a trend, and these false breakouts are just mutton dressed as lamb. We need to have some sign that either the US disinflation story is strong enough and we'll see that dollar weakness, or that the ECB perhaps doesn't need to cut rates at all next year, or if they do, towards the end, Q4. If we get that sort of story, then euro-dollar can be supported from the rates angle. But the problem at the moment, Lisa, equities are rallying, which is a reason to buy euro. It's the reason why we are long euro. We're looking for 114 by the end of September. But oil prices are picking back up, and the rates market in the EGB space have softened in terms of what's priced for the ECB by year end. We think they're done. We think that's possibly the last rate hike by the ECB. So the little bit of market pricing that's left for year end will be disappointed. It's not too much. We are pricing less than one rate hike now. But that is a drag on the euro. But if equities go to 5,000 in the S&P, like your previous guests were talking about, then the only way is for dollar weakness in that environment, in my view.
How disruptive could higher oil prices be, and natural gas for that matter, given some of the recent disruptions and costs on carriers?
The biggest headache I have right now is oil prices, I would say. It upsets the apple cart for sure, because the story is about US disinflation. Energy, before this oil price rally, was down 40% year on year in the US, and if it had stayed at those levels before we had this rally, it would have really dragged down US CPI. But now we've seen retail gasoline prices in the US pick up by 5% towards the end of July, and it could go further. If we break $90 a barrel in oil, I think central bankers will be too cautious, and they'll say, actually, we don't need to even discuss about cutting rates at all. We need to stay higher for longer, or even surprise with another hike this year. We think both the Fed and the ECB are done. But if we have oil go to $90, let's say it goes to 100, that's clearly a mixture of supply concerns, but it probably is due to demand picking back up in a surprising fashion. That will see a few central banks have to turn hawkish in the second half of this year, which we don't really expect. We think that most central banks are close to the end of their cycle. But if we get to 90 to 100, Lisa, a lot of things will have to change in the narratives that are out there.
Jordan, I've got 30 seconds. Is it too early for Aston Villa predictions for next season?
Well, look, I think we're now a top 10 club. That's what we can say after last year.
Okay.
That's a massive improvement of where we were when we had Gerrard.
Jordan Rochester, Nomura, with a subtle dig at Steven Gerrard, of course, the legend out of Liverpool. Jordan, appreciate it, sir. Thank you on Aston Villa. TK not here because he's dealing with the transfer of Harry Kane, potentially, from Tottenham to Bayern Munich.
How is he dealing with that?
Taking it really poorly.
Oh, is that
That's how
exactly
he's dealing with it.
You called him up for
Also
some therapy.
got this yesterday, I have to say, not being covered extensively and should be. And we're going to talk to Anne-Marie about it a little bit later. Governor Ron DeSantis of Florida unveiling his Declaration of Economic Independence. Might be some echoes reminiscent of what the former president said back in 2016, was it, on the campaign trail?
Yeah, talking a lot also about the Federal Reserve and the potential independence therein, or lack of it.
AMH has read through the whole document and listened to the speech, the address from the governor of Florida yesterday. We'll catch up with Anne-Marie in the next hour. Up next, Sarah Hewen of Standard Chartered Bank. From New York, this is Bloomberg.